I have not seen this type of speculation by retail investors in the markets really since 1999. The amount of people that are taking on 2 times leveraged ETFs, single stock leveraged ETFs, call option volume is at levels that have not only not ever been seen, but are levels far beyond what anybody would have imagined even 10 years ago. So there's just been so much of a drive for investors to take on more speculative risk because they've been taught that no matter what happens in the market, they're going to get bailed out by somebody, either the banks or the Fed. So there's no risk to taking risk in their view. Now, eventually, that works out very badly.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap featuring my good friend, the peregrinatory Lance Roberts. Lance, welcome back from the UK.
Thank you very much. Yes, I flew south for the winter.
Yeah. So peregrinatory, it would derive from peregrine. I'm sure everybody knows the peregrine falcon, but references making a journey, perhaps even a bit of a wandering one. And you just spent the past week in the UK. I have not caught up with you about it, so I want to hear the highlights real quick. Folks, you're seeing me in a different location, obviously. I am traveling this week. I'm in Boca Raton, Florida for Rick Rule's fantastic annual symposium. I literally just stepped off the stage, had to rush back to my room. I've got a late checkout here, so this one's probably going to be a little bit of a shorter weekly recap than normal. And in my haste to pack, I packed my suit jacket, which is why you're seeing me a little bit more casual today. Hopefully that's all right. Lance, so the UK, first off, did you make your way to Clarkson's pub? How was it?
I did, and actually, I'll have to send you pictures of it. But yeah, it's in the Cotswolds, and of course, driving in the UK is an experience. If you've never been driving in the UK, the steering wheel's on the wrong side of the car. You drive on the wrong side of the road, and probably the most challenging bit of that was the roundabouts everywhere. So. But my wife was actually doing the driving, and she did a fantastic job. But you get on when we got back out into the country, these roads are very narrow, and in some cases they're one lane. And so if there's traffic coming, you're trying to figure out how to get off the road so people can pass. But yeah, we actually made it to Clarkson's pub, and the Farmer's Dog, and we hung out there for a little bit, and then we drove into we were driving in from Lincoln, and going from Lincoln to Bath, which is where the Roman baths are. We stopped at his pub along the way, so it was a nice journey, a lot of fun, enjoyed. But we were there to see our son, and so we spent 5 days with him. It was fantastic, but as is always the case, it's always great to go on vacation, but it's always great to come back home.
That's good. So usually when I go on vacation, I experience the old adage, no good vacation ever goes unpunished. Are you living through that right now?
Yeah. The good news is that the markets didn't crash. I'm historically known for when I go on vacation, the markets tend to crash, and that didn't happen. So that was the one good positive side. I could actually enjoy my vacation without having a slew of clients, calling, asking about the markets. So, that part was nice.
Yeah, although we did have some extreme market activity, it was just to the upside this time, and we're going to talk about that in just a second.
Sure.
Real quick for those that were hanging on your teaser last time, did you cross paths with, is it Jeremy Clarkson?
Jeremy Clarkson? No, did not. He was not. I did look for him, but yeah, he was not there. So,
all right, okay, folks. Well, we'll have to still dream about maybe pulling him into an interview at some point in the future. Yeah. We do have Joel Salatin. That one's going to come on in 3 weeks or so when I'm on vacation for the week in Ireland. But I'm busy trying to record some videos that are kind of evergreen, aren't market timing sensitive, and so we'll have Joel's out there the week I'm gone. All right, so well, first off, real quick, I did mention that I'm here at the Rick Rule Symposium. It has been a great event, folks. If it's something that you've thought about going to in the past, I can't recommend it enough. I will say, Lance, and we'll talk more about this in our rant at the end of today's session. It won't be a rant. It's going to be more of a celebration, maybe a gratitude session. But I got to tell you, it's been great being here. I mean, there's a lot of great speakers. and you really get to spend a lot of time with them. I spent a lot of time last night on a cruise, having drinks with David Stockman and Frank Trotter, who's the CEO of Battle Bank, the new bank that Rick Roll and he are launching. They're sort of both of the same generation and knew a lot of the same uh, legendary people back in the day. Frank, one of the mentors of his at one point in time was Hyman Minsky. David Stockman obviously has a ton of anecdotes from his days early in DC during the Reagan era, with the likes of Volcker or Reagan himself. So you really get that kind of exposure when you're at an event like this. But I will tell you, a high quality problem I've had, Lance, is uh, it's hard for me to take two steps here without somebody coming up and very graciously stopping me to say how much they enjoy this channel, enjoy our banter as well on the weekly market recaps, but just talking about the importance that it has in their lives, and that, I mean, that feedback is priceless. So we'll talk more about that, but I really just can't express enough how wonderful it is to be out, IRL in real life, which I don't do very often, and get to interact with people like that, and hear that the mission of this channel at least seems to be getting, having the intended effect out there in the world. So it's just
if it'll make you feel any better, I was in Lincoln at a cafe. My wife and son had gone off to do a bit of shopping, and I went into a cafe, and I'm sitting at a table outside on the street drinking a cup of coffee and kind of checking on the markets and stuff, and a gentleman walked up to me, his name was Joseph, and said, "I watch you all the time with Adam Taggart."
So that's so wonderful.
And I'm like, "You're kidding me, right?" I mean, I'm in a different country. So yeah.
Isn't that crazy? Yeah. And that's I will have sometimes people who joke or be like, "Adam, you're famous." And I say, "Well, I'm kind of niche YouTube famous, but it's enough to be stopped in foreign countries." Actually, just coming here to record this with you, Lance, two of the people who stopped me, one was a gentleman from Peru, one was a gentleman from the Seychelles. So it is crazy. This channel does get watched much more widely than I think we fully appreciate. And just to let you know, Lance, one of the things Lance and I have chatted about recently, once the camera was off, was we know that there's a fair amount of Australians that watch this channel, who oftentimes reach out and say, "Hey, is there any chance you guys could come to Australia?" And we've started noodling how we might be able to make that happen. Lance, I met somebody out here from Australia. She's involved in the mining industry, but she also has sort of a social media platform out there, and she's got a couple of ideas. So anyways, folks, if you're from Australia, would like to see the Lance and Adam show come to your country, stay tuned. And if you've got any ideas on how we might be able to make that a little more probable, please feel free to reach out to me directly.
I only have one requirement. I'm not flying to Australia in an economy class. That's a 22, like a 22-hour flight, something like that.
Yeah. So, but basically, you do it for business class. Got it. Business class tickets and Lance is there. All right. Okay. So let's get to the main event, Lance. Melt up. I mean, it's hard not to use those words. I'm seeing them increasingly used in the media.
It's not, though. It's not.
Okay. So that's where I want to start. So, what legs do you think this latest run-up has?
A good bit, actually. I'm actually writing a piece right now for this weekend's newsletter talking about probabilities and possibilities. And again, so first of all, let's just step back, because I'm seeing a lot of the same headlines, right? Oh, it's a melt up. It's a melt up. We don't have any of the underpinnings right now for a melt up. When you're having a melt up, what you have is one is the angle of ascent in the price of the market. In other words, the market's literally going up at a 75-degree angle. And that's not happening right now. We're climbing. We certainly are climbing, but that angle of ascent is very normal for a market move. More of a kind of a 30 to 45-degree angle. That's kind of a normal ascension. Are we getting a little bit deviated from longer term means, like the 200-day moving average? Yes. Are we overbought on a short term basis? Yes. Are we due for some type of a pullback? Yes. But melt ups are a function of sentiment and a function of positioning. And neither one of those are at extremes by any measure. We've gotten more elevated here recently for sure. But remember, we were coming off, and you and I were talking about back in early April. I wrote the article called The Hope and the Fear, and that was on April the 7th that we published that article. And we talked about it on the show that week and saying, look, we have not seen sentiment and positioning this negative since the financial crisis. And so this rally that we've seen since then has been a function of the recovery of that very negative positioning and sentiment. But we're not back to extremely exuberant levels. We're starting to push more into greed levels, absolutely. But if you look at professional investors, CTAs, they're about neutral. They're not over their skis in terms of leverage or positioning. We're not seeing a massive short covering at this point. We're seeing some. But we're not seeing the type of speculative positioning and sentiment that you would see in what would technically be termed a market melt-up. Adam, you'll remember the last market melt-up we had was in 1999, and you remember in late 1999, starting in November, the Nasdaq went up 100% like 2 months. That's right. A melt-up.
No, that okay, yeah, that is bananas. We are not there.
Yeah, and if you look at a chart, it looks like this. Right. And so it's the problem with the melt-up scenario is that it's great for feeding on fears and those type of things, but we don't have the dynamics for melt-up. And so so the purpose of the article this week in our newsletter is I'm kind of breaking the market down into possibilities and probabilities. There's about a 50% probability over the next 3 months that this market could rally further. We've got earnings season coming up, which the bar is set very low right now for earnings. So it's going to be very easy to have a good beat rate by corporations for earnings. Buybacks will return beginning in August. So beginning August 1st, corporate buybacks will come back because, the earnings season is starting to wind up at that point.
The blackout windows are over. Yeah.
Yep. And right now, buybacks are at a record this year. Buyback announcements have set another record this year. So we're going to have over $1 trillion worth of buybacks in the markets between August and October. Between August and the end of this year, we'll hit somewhere around $1 trillion in total buybacks for this year. So that's a good chunk of buying for the markets. And again, if the economy is doing okay, which it is, we don't have any real sign of economic recession on the horizon right now. We certainly have some signs of slowing, but there's nothing there that's going to degrade the potential for earnings to continue growing. So the issue over the next 3 months, the next quarter, is that if earnings come in better than expected, then markets are going to start to price up forward expectations. So we'll see expectations for third and fourth quarter increase. And that's going to help, stabilize valuations in the markets. Remember, markets trade off forward earnings. So that's when we have about a 50% probability this market could rally more over the next 3 months. What about the other 50%? There's about a 35% probability we get a 6% correction between now and sometime in August, September, maybe early October. That 6% correction would take us right now back to the 200-day moving average, roughly. That's a good support level for the markets, right around 6,000, maybe 5,900. If tariffs are reset August the 1st, we have a big jump in tariffs. He doesn't back off of these tariffs, and we don't go back through the stick and carrot negotiation thing. And that begins to weigh on markets and forward earnings outlook. That's where you get that correction. So that's about a 35% probability. The other 15% is a market that just chops sideways for the next 3 months and drives everybody crazy. So there's the premise for that kind of scenario is that there's a lot of momentum and bullish sentiment in the markets, a lot of optimism going forward in the markets right now. And if we get some type of higher tariff, but not onerously high tariff, then markets may have to digest that for a while. So, and again, work off some of these overbought conditions. So that's kind of the layout for the next 3 months. Predicting beyond that, it's a fool's game, but that's kind of what to look for potentially over the next 3 months.
Okay. So let me ask you a few questions about that. So it sounds like 50% continued bull rally from here, right? So that's the majority outcast.
Yeah.
Or outlook. First off, I just gotta say, Lance, before you left, you might remember you had said okay, so now that we've had the pullback, the markets are likely to go higher. And I said, wait a minute, what pullback? And you said, oh, that tiny little wiggle, right? And a lot of people said, Lance is using a microscope to find that quote unquote pullback. So one, I just want to let you know that there was a lot of people being like, all right, Lance was sort of telling us that there was to expect a pullback. We were expecting something a lot more material than what we saw. But it does sound like that you think that the preponderance of probability at this point in time is higher, that whatever was making you worried about a pullback, we're past that right now.
No, look, I'm always worried about a pullback.
No,
That's
I
my
know. I
job,
mean, you give
right?
us the other 50% odds
Yeah.
of what could happen here, but you're
But
still getting
yeah,
50
just
to an
based on where
upfront
we are,
there.
and look,
Yeah.
and that doesn't look, and so two things too, right? So even when you look at the 50% bullish outlook, right? There's not a lot of upside in the market. So just because we say, look, the over the next 3 months, this market could be higher than where it is today. It could be slightly higher. It could be 1 or 2% higher in the next 3 months. I'm not talking about a 20% rally. And we had a 25% rally from the April lows to where we are now, right? We're not going to do that again over the next 3 months. Markets might be slightly higher over the next 3 months. If you break it down into risk reward, the downside risk outweighs the upside reward. So if I was an investor today sitting 100% in cash, I would deploy about 30% of that cash today. And I would do that in more probably low beta, low volatility type stocks, companies like Berkshire Hathaway, Visa, those type of Procter and Gamble, Coke. That would be more of my, kind of issue of going in, because the risk reward setup, particularly in high beta names, high beta is extremely overbought. I just did some analysis this morning on Twitter or X this morning, but high beta is extremely extended and overbought. You're going to have a correction and a rotation within the markets. And it doesn't necessarily mean the market has a big drawdown, but you could have a really rapid rotation within the market that's pretty violent. And if you're heavily invested in small cap, high beta names where there's a lot of risk, you could have a much bigger drawdown than the market could be flat and you could be down 10% because you're misallocated within the markets. So you got to be careful, one, when you talk about kind of the market, because that's a general nomenclature. We're talking about an index, and that's very different than how a lot of people are invested currently. Right now, I'm seeing a tremendous, and I wrote about this last weekend's newsletter and the week before, talking about, I have not seen this type of speculation by retail investors in the markets really since 1999. The amount of people that are taking on 2x leveraged ETFs, single stock leveraged ETFs, call option volume is at levels that have not only not ever been seen, but are levels far beyond what anybody would have imagined even 10 years ago. So there's just been so much of a drive for investors to take on more speculative risk, because they've been taught that no matter what happens in the market, they're going to get bailed out by somebody, either the banks or the Fed. So there's no risk to taking risk in their view. Now, eventually, that works out very badly for a group of people. But again, we're talking about the broad index, which is what you and I are talking about right now, the S&P index. Within that index, there can be very violent rotations between high chase momentum, high beta names, the Oklos of the world, the GE Vernovas, the Palantirs, some of these stocks that have run 60, 70, 80% from the April lows. Those can have 20, 30% declines. That wouldn't even break their bullish trends at this point. So, but at the same time, when those are getting sold off, you're going to see money rotate into lower beta, high value names like Berkshire Hathaway, like a Visa, like a Procter & Gamble, like a Coke, like a Costco, a Walmart. Those will hold up much better in that type of an environment. So you could have one group of investors that have a flat return over the next 3 months, and you have another group of investors that are down 20%.
Yeah, okay. So let me ask you this then. Obviously, that's concerning, right? Mm-hmm. 1999 levels of speculation amongst retail investors here.
Yeah.
And if I just heard that alone, I would have thought that in your probability list that there would have been a section in there for like some sort of market drawdown, right? Mm-hmm. But it sounds like you see it's going to be more of a rotation into the lower beta element. So are you including that in the 15% chop?
No. Now you're talking time frames. Those are different. Talking about next 3 months.
Yep.
We don't have a catalyst in the next 3 months to create a .com crash, right? Earnings are fine. Earnings bar set very low. Economy's fine. There's no real financial crisis issue on the horizon right now.
Yeah.
You
But
know,
I mean,
but hold on.
but do those catalysts telegraph themselves, or do they by definition
No,
have to be a
yeah, but
surprise?
no, yes, they will. But those things are things that take a lot longer to mature. So what we're talking about right now is over the next 3 months.
Yeah.
Look, I said this on the radio the other day when I was doing our show, is that we're going to have at some point, I don't know when, and like I've told you before about predictions, is that if somebody comes on your channel and says, hey, this market's going to crash by 50%, okay, tell me when exactly, tell me what's going to cause it exactly, and tell me exactly how to position for it and when it will be over. Because if otherwise you can't do that, a prediction is not worth anything. If I say the market's going to crash 50% sometime in the future, that's useless, right? Yeah. We've had people calling for a 50% market crash for the last decade, right?
Just to be clear, there are a few names in that space that have been doing that for many years that people have been begging me recently to get them on the channel. This person's been predicting this, get them on. I'm like, yeah, they've been predicting it for 8 years. Like it hasn't been useful, right? Yeah.
Exactly. And so here's what I do believe, right? I do believe that at some point in the future, we're going to have another 50% correction. We will have another financial crisis type event or a .com type event. Those were very different. One was credit related, one was balance sheet related, earnings related. Yep. But we'll have some event. What causes it, I don't know. But I think that's going to probably be in the 2030s. Before we get there, I think there's so much momentum behind this markets right now. There's so much money coming in. And that was really when you kind of look back. We talk a lot about the .com crash. We say, it was like 2000, the .com crash. We got to remember that whole rally started in 1990. Here's an interesting stat for you. In 1990, 80% of investors in the markets in 1990 just started investing. Because after 1974, people left the markets. They were like, I'm done. The black bear market wiped people out. They're like, I'm never coming back. And they never did. And so about 80% of all investors that started in 1990 had just started investing at the beginning of that bull rally between 1990 and 2000. In 1995, 80% of investors were new investors that had never invested before.
Right. And started
because everybody rushed in.
Well, and remember too, from 95 onwards, that's when you started having the E-Trades of the world, and it began to become a lot easier for the individual to start opening. And of course, they were marketing to them and kind of fanning the FOMO.
Exactly. And that's why there was such a big surge of individuals, because of that availability of investors to just buy everything. The reason I say this is important is because that was a 5-year run from 1995 to 2000. So they can last. These bull rallies can last for quite some time. But think about today, Adam. I have Robinhood now. Didn't have Robinhood even back then, but now I can just pick up my phone. I can open up an account with Robinhood or a variety of different brokerage firms, Webull, whatever. Public, start trading stocks on my own. I don't need an advisor.
Free to trade. You can buy fractional shares. I mean, it just is so easy.
So I'm bringing in all these individuals, and there were 700 new ETFs that came to markets last year. And again, we just have ETF people or, ETF companies are just generating product as fast as they can right now because there's so much demand for product. And this is also a warning sign. It's great that all these ETFs are coming to you, but that's also a warning sign because again, that's just a function of demand. And, now there's a big push to get private equity to be kind of public equity, which will kill the whole private equity market at some point. But we want to now get people invested. We want retail investors to get invested in public and private equity, and so it's going to be a very bad outcome of that eventually. But there's so much money chasing so few assets right now that it's going to take time for whatever event to occur to break that bubble. And so again, that's what I'm saying. It could happen 2 years from now. It could happen 3 years from now, but if you kind of look historically at timeframes between major crashes, those type of things, timeframes between recessions, it kind of puts the next one around early 2030s.
Okay. And again, as you always say, Lance, valuations are terrible timing indicators. So it could happen tomorrow, but given the current landscape, Lance, you're not seeing anything that is flashing big
Yeah.
warning signs of something major like this. I totally get it. All right, so let's move on to uh, the coming earnings season. You just wrote a piece on your site about Q2 earnings preview and what we might think might be coming. So I'd like for you to summarize that for folks real quick. There's been some hiccups in the video here, at least on my end, Lance. I don't know if you're seeing the same on mine. That's probably due to my hotel connection here, folks. There's really not much I can do about it. Hopefully you're getting the preponderance of what we're saying. We're going to keep soldiering on, but I just wanted to apologize if you are seeing some of the same freezes and hiccups that I'm seeing. So as you tell us about the earnings season, Lance, just in your answers, if you can address this. So I've taken good notes in my recent conversations with you. I think you still believe that forward earning estimates are still unrealistically high.
Yeah.
And that at some point the market, unless we get more economic growth than we're expecting, at some point the market's going to have to reprice for that. If I heard you correctly a few minutes ago, you said that earnings expectations for Q2 are pretty low, and they always get marched down. So just help us understand where the delta is between too low today and too high tomorrow.
So yeah. So first of all, yeah, this is a very interesting. Let me share a chart here with you. So this is the estimates. This is the evolution of estimates. So this is from S&P itself. This is the company that actually, produces the S&P 500 index. So I use their earnings estimates. Now there's FactSet, there's other companies out there. And what FactSet does is that they take estimates from all the Wall Street estimates, but this is directly from the index provider itself. So I figure that's probably the best, measure of earnings estimates is what they're predicting for their own index. But what you'll see is that we started in the first time that S&P put out estimates for the S&P 500 index for 2025 was in March of 2024, and they said, "Oh, earnings are going to be $234 a share." We're now down to $220 a share as of June 15th. So that's a $14 reduction on estimates going in. So that's a pretty deep cut to earnings estimates going forward here. But once we enter the next quarter, all of a sudden there's a 15, there's like a 10 or a 12% jump in estimates for next quarter. In other words, there's going to be this massive rebound in earnings over the next quarter and the quarter after that. Now, again, what'll happen is that when I start posting up for Q3, you're going to see the same type of chart for quarter three, because as we get closer to quarter three estimates, those will start getting cut. But this is always the game. Now, when does that matter? It doesn't matter that these estimates are getting cut as long as it's a gradual rate of cut. So kind of think about boiling a frog, right? As long as I boil a frog very slowly, he doesn't know what's going on. But that's kind of what happens with earnings, and markets just look past it. They're like, oh yeah, they're getting downgraded a bit, but everything's great. Markets are going up. It's all awesome and it's fantastic. And then this is the whole millennial earnings season where everybody gets a trophy because we cut those estimates so much. We'll have about an 80% beat rate. So at the end of this quarter, everybody says, that was a great earnings season. We had 80% of companies beat on earnings and revenue. It's fantastic. And the market goes, oh, this is awesome. So we can justify 22 times earnings because next quarter, we're going to be back up to $234 a share. So based on that number, valuations are only 20 times earnings, not 22. And then we're off to the races again. And then we gradually slow them down. Where it matters is when something happens. And this could be something like August the 1st. So let's just play a little hypothetical here. August 1st rolls around. Trump says, you know what? Nobody came to the table. We're going back to the original tariffs that we had back on Liberation Day. And in fact, not only that, but I'm going to slap another 50% tariff on everybody just because they ticked me off. And the markets aren't ready for that. And so markets would then have to immediately adjust earnings. So when you have a big adjustment to earnings, in other words, you're at 234 today, and then August the 1st, it's 215. That's where you get the big reversion in the markets. That's where the markets, we saw back in April. And that's exactly what happened back in April. If you remember, we had that 10% drop.
Right.
That was because those tariffs were having to be factored into what forward earnings were going to look like. And so when something unexpected or exogenous happens that affects that forward outlook dramatically, that's where you get the market impact. As long as it's just a grind slower where we're boiling the frog, so to speak, markets don't really pay much attention to that.
So this may actually literally be what it happens, but what I hear you say, Lance, is if it's the slow creep, right? Then the Wall Street analysts are like, yeah, that's kind of what I have. I mean, maybe it's a little bit less than what I put in my model last week, but it's still in the same ballpark.
Yep,
If it's something that causes them to say, oh my God, I got to rush back to my desk and update my model, that's when we see the quick repricings.
that's correct.
Yeah, yeah,
Yeah.
okay. All right. Well, look,
And
let's
that article's on our X, X account right now. So if you go to Substack at Lance Roberts, or if you go to X as well, I'll have that article posted here shortly up on all those platforms. So if you're not following me on Substack, go follow, and then after the interview, I'll have that article posted. But it goes through all the drivers for earnings, et cetera, for the second quarter, what to expect. So there's a good bit of data in there.
Okay, so two things about the earnings seasons. We know the bar is low to your point now. We're going to find out whether they step over it or not. I mean,
Yeah.
odds are likely high. Have any companies started reporting yet,
Yeah,
or?
we had Delta come out reported. Delta's kind of kicks off earnings season. I don't know when it changed. It used to be Alcoa a long time ago, but Delta was kind of first this week. And they did a good bit of cost cutting measures. I kind of made a joke on the Real Investment Show this week. I said, yeah, the airlines are figuring out a way to become much more profitable. I said, pretty soon there's kind of the subway handles that you go in, you just stand up as you fly, so they get more people on the plane. But Delta announced pretty decent earnings, more cost cutting measures helping improve profitability. So so far so good. But again,
Okay.
next Thursday and Friday, we have the major banks kick off. So we'll have JP Morgan, Wells Fargo, BlackRock, et cetera, late next week. The following week, we'll start getting a smattering of your big companies, and they'll really start reporting. The next week after that, you're going to get all the Mag 7s. You'll get Meta and Apple and Tesla and those guys. So after next Thursday, Friday, things are going to get pretty frenzied in the markets.
Okay, and it really is less what the earnings results are, right? And it's more
Mm-hmm.
about the forward guidance.
Yeah, I think that's going to be the key driver. So if you're looking for something that might undermine the market over the next, next month or so, and again, downside risk is certainly present in the market. So I don't, when we're talking about probabilities and possibilities, there's a decent probability that this market can have a correction of up to 6%, over the next 3 months. And one of the drivers with that would be outlooks and earnings, where they say, hey, our earnings were fine for the second quarter, but these tariffs are going to kill us in the next quarter. The markets are not prepped for that.
Yeah.
Our
So I
earnings
mentioned,
estimates are way too elevated for that type of an announcement. So forward guidance is going to be crucially important during earnings season.
okay. So I mentioned I had drinks with Stockman on the cruise last night, and I did ask him this question because he's no fan of Trump. I mean, that's no secret. He bangs on the table about that every day, and he thinks that you know everything's going to end in tears based on the policies that the president is currently pursuing. And so one of the questions I asked him, because he was on a long tirade about how these tariffs are so disruptive to corporate planning. Yeah, I said, okay, so there is a fair amount of economic activity that has not been happening, right? Certainly in the first couple of months after April, a lot of corporate execs were like, look, we don't know what the future is going to look like, so we're not going to deploy a lot of capex right now because we don't know what kind of future we're investing for. The dust is somewhat settling, but still, every day this week alone, there've been a ton of new tariff surprises, right?
Mm-hmm.
The tariffs on 10% tariffs on BRICS countries. He's, thrown a 50% tariff on Brazil and 50% tariff on copper, right? I mean, there's just surprises still coming left and right. I think we just re-up tariffs again, or the threat of tariffs on Canada. So there still is a lot of uncertainty swirling out there. So that economic activity that otherwise would be happening now still isn't to some certain degree. So my question to Stockman was, so are we setting up a lag effect here where there's going to be sort of an air pocket that we experience in a quarter, 2 quarters, 3 quarters, where we would have expected to see the results of normal economic activity over last quarter and this quarter, but we're not going to get it because there's been reduced activity? What are your thoughts on that?
Well, first of all, the macroeconomic data is not fantastic. right? So if you actually take a look at the stock market, all right. So here, let me back up real quick. So let me show you this chart. This is actually from the article that I just published this morning on earnings. So this is an economic composite index that we create. This has more than 100 data points in it that cover both soft and hard data. So it covers ISM manufacturing, ISM services, leading economic indicators, Chicago Manufacturing Index, all the Fed regional indexes, so forth and so on, right? So
This
it's a
is the
lot
everything bagel of indicators.
Yeah, it is. It's the everything bagel with even some extra sprinkles on it.
Okay.
So that's the red line. The black line is the annual rate of change in the S&P 500 earnings, right? Right now, we've had a fairly sharp deterioration in the economic data, but the earnings are still pretty elevated. And you see that in the blue circle on the right. And you can see the historical correlation. It's pretty high. And that makes complete sense, right? Where does corporate revenue come from? It comes from economic activity, right? So it's you and me going out to Walmart to buy something, or going to Costco, or going to Home Depot, or whatever. That's how they generate their revenue. And from that revenue is where their earnings come from. So without economic activity, how can earnings stay extremely elevated? Well, buybacks and some other stuff, but you get the idea. So right now, there's this attachment between the market and slowing economic activity. Now, the economic activity isn't terrible. We're not falling off the cliff and going into a recession right now, but it certainly doesn't, if you want to look at it into an isolated bubble and say, is economic activity supporting the market? No, it's not. The market is detached from the underlying economy, and that can happen for fairly decent periods of time. So, I mean, it's not like a crash warning indicator, but it does tell you that unless the economy begins to recover rather sharply, earnings estimates are going to come down. And when you apply, the tariff impact and that on top of it, there's a potential risk to earnings going forward. Not so much to inflation. Tariffs aren't inflationary for a whole variety of reasons, and I've got an interesting story to tell you about that. But they are important to the manufacturing of earnings by corporations, because corporations, the producers, are the only people that pay tariffs. Consumers do not pay tariffs, only producers.
Okay, and this is really interesting. Yeah, I'm looking here, taking out kind of the outliers there of the global financial crisis and COVID. It seems more or less every time the black line, the year-over-year change in the S&P pokes above the red line, the S&P is then followed with a negative return. In other words, that it's the S&P that corrects back.
Well, be a little careful with that, because the axes are different. If you'll look at the right axis of the S&P, or annual rate of change, the center line is 0. So you have positive earnings growth and negative earnings growth. The index is a 0 to 100 index.
Right.
So
the data's been pretty tightly correlated on this.
But that's a little bit of chart alignment. But that was really just to show there is. But to your point, I mean, I'm just saying, don't look at it from the function of when it's above the red line. It's really not that. It's just that when you see the downturn in economic activity, like in the financial crisis, you had that very sharp drop off in economic activity, and earnings were right with it. That's what you would expect, because earnings are a function of economic activity.
Okay. Yeah. But so I guess more or less we're sort of saying the same thing, which is that we would expect the black line to catch up to the red line here. Or
vice versa. One's got to catch up with the other.
Okay.
Right.
Yeah. All right. But presumably, if the economic conditions continue weakening, stock can't ignore that forever.
That's correct. No, that's the whole point. And then we start getting into third and fourth quarter, where these analysts, which have very lofty earnings expectations in third and fourth quarter, those have to get cut. So if earnings grow, see, this is the whole premise by economic analysts, is that somehow we're going to have this magic recovery in the economy, and we're just going to have this boom in the third and fourth quarter, economically speaking. I don't really see where it's going to come from, because employment growth is slowing. We're at 147,000 in the last report. We're not generating 200,000 plus or 300,000 plus jobs like we were. We're down to about half of that, and that's continuing to kind of grind lower. Consumers are clearly, we're starting to see rising delinquency rates. We've talked about all that stuff. I mean, consumers certainly seem to be coming under more pressure. Consumers are the ones that drive economic activity. That's 70% of the equation. So I don't really see where the evidence is that you're going to have this massive recovery in economic activity. I think it's going to be more of this slow grind over the rest of this year, which is going to make those estimates have to come down at some point.
Okay. Interesting. You used the word slow grind. It's exactly what Stephanie Pomboy said earlier this week, where she thinks the probability is more likely we'll just continue kind of grinding and largely towards a slowing economy from
Yeah.
here. And to your point too, to one of your cautions, she's totally open to the fact that there could be some sort of event that catches everybody by surprise and bang, economy falls into recession. But she thinks the majority of the probabilities are more just sort of this slow grind, right?
Yeah.
Um,
Can I show
also,
you just one more
go
chart
ahead.
about this before you get off of it?
Yeah.
This topic, and then we can move on. I just want, I can't reiterate how important consumption is to this whole equation. This is a chart. So the red line is S&P forward earnings, right? Year-over-year rate of change, just like I showed you a second ago, was just black in the last chart. The black line is personal consumption expenditures. And so the point about this is that, again, with personal consumption expenditures slowing, I don't see how you can maintain exceptionally high estimates in terms of earnings growth. Right. It's just because that's where earnings come from, is from consumption.
Yeah, that's such a great point. And this is where I have trouble getting my brain off of this these days. We have a weakening housing market,
Mm-hmm.
right? So there is a negative wealth effect associated with that, right? And housing is much more widely owned across America than stocks. Um, and we have this, what I think could be contagion from student loan repayment, right? And folks have heard me tell this story, so I won't repeat it here. But basically, where the fact that you've got to repay these student loans that have gone back into repayment, um, it is compromising people's ability to service their other consumer debts, right? And so all of that weighs on consumption, Lance, right? And so that I'm not even considering layoffs or anything like that in there, right? But I just see that as both of those trends, to the extent they continue from here, and they look like they're going to continue for at least the next year or two. That's just going to increasingly weigh on consumer expenditure.
Yeah. No, look, and that's why also too, when we come back and we talk about tariffs, there's this, all these headlines about how, and look, I wrote the whole article about, the Fed's caught in this transitory trap. They should be cutting rates right now, but they're not, because they're too worried about this potential tariff inflation. But you take a look at what's happening economically on the consumer side. The risk is still disinflation over inflation at this point, and particularly with just when you start talking about the big drivers of inflation: housing, transportation, consumption, in terms of food. Those are the big drivers, and we're starting to see people step down. I mean, Walmart, Costco, et cetera, they're starting to see improvements in foot traffic as normally higher end retail shoppers are now stepping down to lower cost producers of food and those type of items.
Right. Stop and shopping at Whole Foods and doing my
Yeah.
grocery shopping at Walmart
Yeah.
or Costco now. Yeah. Okay. So I have an interview with Michael Kantrowitz, famous for his hope framework in terms of how the economy rises and falls.
Mhm.
And that's coming out tomorrow, so the day after this video. And the punchline is he's not super worried at this point in time, kind of like you, Lance, like not in the immediate term, right? Like his let's say 3 month headlights on his car. Things seem to be holding together okay-ish, right? Definitely some cracks to point to and stuff like that, but it just doesn't seem like from his framework that the wheels are going to come off anytime real soon. And from a market's perspective, he sees us back in Goldilocks, which is definitely an extreme, right? And he's saying that this is uh, definitely an extreme where the market is pricing in the least degree of macro risk right now. One of the most extreme times in his data set. And it doesn't mean the market, is going to roll over tomorrow, right? In fact, he's not even sweating it that hard right now, but it makes the market much more reactive to surprises,
Mhm.
right? When everybody is sort of maximum complacent, anything that is not perfect has the ability to send the market responding, much more violently than it normally would. Um, And I kind of asked him, so I mean, is this like a bubble in search of a pin? And I don't think he said exactly that, but he's like, it's more like that than not, right?
Yeah.
Yeah. And so I think the worry here for the skeptical investor, right, about today's valuations and who has concerns of the macro ones like you and I have about consumers' consumption. Um, the big question on people's minds, and this is really maybe the heart of today's discussion, Lance, is okay, so how do you ride and how long do you ride the uptrend when the market is kind of priced for perfection and there are swirling pins out there, known pins that could puncture confidence?
Well, so the thing that gets investors in trouble is, we talked about this before, is doing this all or none thing,
Mhm.
where it's like, oh, these valuations, I need to get out of the markets right now. I'm 100% cash now, right? I'm out. Don't have to worry about it. The market just keeps going. And it's interesting because we see this a lot, and this is why we talk so much about risk management here, which is understanding that there is risk in the markets. Here, let me show you a chart of something, because there's a really good story behind the NVIDIA, as you know, just hit $4 trillion in market cap this past week. This is a chart of NVIDIA. What's important to note is that during this entire kind of rise in the stock, there's been a lot of stories about, oh, the stock's going to crash. It's, it can't support its valuations. Oh, DeepSeek is going to kill NVIDIA. AI is dead. You've interviewed people that have even said, hey, NVIDIA is a huge short position, right?
And you and I have made comments like, and at some point, competition's going to be able to,
Sure.
start to catch up and eat away at their margins and yada yada. Yeah.
Yeah, absolutely. But we own NVIDIA. We've been long NVIDIA for a long time. And when back in really kind of early March, late February, we started reducing our positions in NVIDIA because they were very overbought, extended, those type of things. We didn't sell everything, but we reduced that position size. When we were starting to get into the whole sell-off in April, we cut that position even further. We bought it back after April the 7th. We wrote that hope and the fear. We added back to that position because markets were starting to change dynamics at that point. And the stock had gotten deeply oversold, got down to its rising bullish trend line, and is now rallied back to all-time highs. So the point is to always separate out, and I'm just picking on NVIDIA right now because it's such a darling of the markets and everything else. And everybody's got, there's lots of bullish commentary, lots of bearish about NVIDIA. So it's a great kind of stock to work with in terms of analysis. But this applies to the markets. This applies to every stock, every index. It doesn't matter what you own. When things get extremely extended, this is why it's important to take profits, because eventually you're going to have a correction because of just one reason or the other. Here's another good example, right? Gold has had a huge bull run, and it's doing fantastic. And along the way, it's had some decent corrections, and it's currently in this big consolidation process right now. But that's because it got extremely overbought. So again, when it got extremely overbought, you and I were talking about shows, hey, take some profits here because you're going to get a pullback. And then a couple of weeks later, it's like, hey, you're back on a pretty good bullish, kind of buy signal. And you were shocked I would say that. But I said, you're good. You've kind of worked off that risk reward. Now it's a better entry point than it was just a few weeks ago. So the point about managing money is always this, is not about being all in or all out of something. It's about understanding how much risk you're taking to be in the markets and then navigating that risk accordingly. A good conversation that we had this morning is talking about beta versus momentum. And if you take a look at sectors in the markets right now, we're starting to see a very interesting, I'm looking for a specific chart. And I don't have it, so I'll have to come back to it. But in the markets right now, there's a big move that's happening between momentum and what's happening with like low beta stocks. And right now we see, for instance, low beta is very out of favor. Like nobody wants to own low beta stocks right now. Everybody wants to own high beta. High beta is the most overbought sector in the entire market. So everybody's chasing anything that's going up rapidly, small cap stocks in particular. They're extremely overbought right now. Nobody wants to own low beta. And so when you have a deviation like this between high beta and low beta, that's almost always a good setup to take profits out of high beta. It doesn't mean sell everything. And so if I dig down into looking at what's in high beta, right? So what names are there? Well, it's Atmos Energy, it's CME Group, it's Kimberly Clark, those type of things. So we're looking. Sorry, that's low beta. Those are the things that you want to kind of look at. So if you own a lot of high beta stuff, this is a good time to say, take some profits there, reduce that position size, and then rotate that cash into low beta, because if the market corrects, that's where money's going to go to. So again, it's just about navigating risk. You can stay invested in the markets always. There's never a reason not to be invested, but where you're invested is the key point.
Great point. Let me just clarify for folks. So when you're saying high beta and low beta, high beta are companies that are highly attuned to the market direction,
Correct.
Right? So if market goes up, these things go up.
It's what everybody's chasing at the moment, right?
It's what everybody's chasing at the moment. Yeah. And the flip side of that is a low beta stock. It's not that it goes the opposite direction of the market. It's just that it doesn't have a correlation to the market, right? Market does whatever it wants to. These stocks they beat to their own drummer, right?
Right. And they're more value oriented. Here's high beta stocks as an example. So it's AMD. If we look at the most overbought high beta stocks, it's Tesla, Monolithic Power, Palantir, Micron, Broadcom, AMD. The winners you would think, Vista Group, Microchip Technologies, SCMI. That's exactly what you would expect to be in that group. So those are all your high beta names. And right now they're all clustered in the upper right quadrant on a relative score basis to the market. The only one's really out of that factor right now is Tesla, but it's dragging for a different reason.
Yep.
But if you're in those names, that's where you start thinking about, okay, why don't I reduce? So, and again, talk about position sizing. Let's say that I own 2% of every one of those companies in my portfolio. They all make up 2% of my portfolio. Now they're 3.5% of my portfolio because they've had each position is now 3% of the portfolio because they've had a huge run. Trim them back to 2%. Take your profits and then go buy some of those low beta names, or go buy some bonds, or go buy some, something else that's deeply out of favor right now, and allow the market to rotate back to you, because it will. Because when we get the correction, this is where all the money's hiding right now in high beta names. Nobody wants to own low beta because they're not making any money with it. So I sell that and I buy the high beta stuff. But when that corrects, money's like energy. You don't destroy energy, right? Energy just changes form. And that's all that happens in the market. Money doesn't leave the market. It just changes where it's hiding. So it sells here, and when people start seeing that get sold off, they go, oh my gosh, I got to get out. So they sell their NVIDIA position or whatever, and then they go buy a Coke, which is now starting to get money flows. And we start to see the recovery in the market in those areas because money's starting to hide there for safety and dividend. And so then you participate there as well. So this we actually have a whole model that we use in our office, which just looks basically at the rotation between high beta, low beta. And when you see that correlation begin to flip, that's when you know to take profits and rebalance your risk in your portfolio. But you can stay 100% invested in stocks all the time. It just depends on where you're invested.
Where you are, exactly. And just to sort of finish my inquiry here, when the market is richly valued, then the risks of being too exposed to the market if it corrects get a lot higher, right? And to be in low beta stocks, there's sort of two rationales for it. One is, if you're in a low beta stock and the market corrects, it's likely not to be impacted because it doesn't have much beta. I mean, it doesn't have much correlation to what the market does, right? So it's sort of a way to sidestep the market downturn, which can be an easier way to play that. Like you could go short, but then the market might continue going up and you're going to lose your pants. Whereas if you're sitting in a low beta stock, it's largely going to go to the beat of its own drummer. If the company's well run, it'll probably still do okay. Market corrects, not going to be that impacted because it has low correlation with the market because it's low beta. But to your point, Lance, you then also have the optionality that if the market says, hey, I'm kind of getting beat up on these high beta stocks now, maybe I want to look at something that's a little more, little more boring in a good way, then they go into low beta. And so you get the pop from that too.
Yep, exactly. But again, how you manage your portfolio is entirely up to you. But the one thing that impairs investors over time more than anything else is they hear a bearish headline and then they sell everything and go to cash. and then the market keeps running up, and then so finally they get, well, that was wrong, so I've got to get back in now, and that's when they typically buy the top of the market,
Well,
and they get caught on the next downturn.
so yes, but I would say the problem is actually at a level above that, which is that, and understandable because we're people, right?
Mm-hmm.
And we like to keep things simple because there's a whole zillion other things our brains need to focus on. And so we tend to take kind of a binary in or out approach.
Yep.
So whatever we're doing, it's like, okay, well, it's easy for me to be all in on that, right? Or and the
It's all
ability to
out.
kind of layer a well-diversified portfolio and have all these different positions, and I have this for this reason and that for that reason. For the average person, it's really hard to keep all that in mind unless you're a full-time DIY investor. And if you are and you've got experience, great. And you're successful at it, great. Keep doing it. But if you're like, as I say all the time, if you're a regular person, that's really hard to do. So if you find by taking, if you like take an honest inward look and say, you know what, I'm kind of maybe one of those people who's just sort of all in on whatever my thesis is, and yeah, sometimes it works for me, but man, sometimes I get really clobbered. This is where you want to recruit the professional help to say, hey, doesn't mean you still can't do the trades that interest you, but on kind of keeping a well-diversified garden and making sure that, okay, I know why I'm in these positions and I know what their specific strategy is in my overall portfolio. That's where like an advisor can really help you by just offloading all that work that you should be doing, but highly likely probably aren't because you're human.
Yeah. And look, I mean, managing money is hard because nobody wants to lose money. That's it's just like, I've worked hard for this money. I don't want to lose it, which I find fascinating, right? Because people say that it's like, I don't want to lose my money, but I'm going to go buy the highest beta volatility stock I can find, and I'm going to put it all in there. So people are very funny about how they measure and quantify risk mentally. But, the point is that, investing is a long-term game. And as long as you can navigate the risk profile. What I mean by that is we all have a different level of risk tolerance, and you can throw out all those, when you go sign up for an advisor, say, here, take this risk profile questionnaire, and the questionnaire says, if the market goes down 10%, are you going to buy more, sell everything? What are you going to do? Well, it depends on what the market's doing. If the markets are going up, everybody says, no, I'm not going to sell anything. I'm going to hold. If markets are crashing, they're like, I'm selling everything. So,
right.
Even the risk profile questionnaires are useless because they don't account for what actually happens during market declines. And so this is where you've got to really be honest with yourself. When you look at your portfolio, markets are doing fantastic right now. They're great. We're up 25%. Everybody's forgotten about that near 20% decline that we had in March and April. That's ancient history. But I can tell you for a fact, I had a lot of clients calling me and say, why aren't we selling everything and getting out? This market's about to just, it's just about to crash because of tariffs and all this other stuff. And I'm like, no, it's not. But here's where we are. But think about how you felt then. And were you on the cusp of selling everything at that point when the markets were down 20%? Importantly, look at your portfolio. Was your portfolio down more than the markets? If it was, you have too much beta volatility.
Probably have too much risk, yeah.
Yeah. So, but be honest with yourself and go, as an individual, and I know my tolerances, right? As an individual, I cannot stomach, if the market's down 10, I cannot be down 10. That's just not in my wheelhouse to do that mentally. And I know that. I'm aware of it. I'm also aware that if the markets are up 10%, I want as much of that 10% as I get, but I know I can't get all of it because I'm too conservative as an individual. So the whole portfolio is balanced and tailored to limit that downside risk to some degree. It still doesn't mean the portfolio is not going to be down. When the markets were down 20, our portfolios were down about 4.
Right.
So I'm still down, right?
But down 4 is the new up when the market's down 20.
Yeah. But, I'm still down. So you're going to lose money when markets are down. I mean, there's just no way around it. You have to be willing to have a limit to where I can live with that down, and then be willing to give up some of the upside when the markets are rallying, because you can't have both. You can't have all the upside and none of the downside. That just doesn't work. But if you can come to an agreement with yourself, I can build a portfolio that will generate this rate of return over time with this much volatility risk, and be good with it, you can stay invested all the time as long as you're managing that profile.
Yeah, and this I just want to underscore this is very important, but it is really hard, right? I mean, Lance, how many clients have you had that have said, "Hey, I'm that client, Lance. I'm happy to have you shave a little bit of the upside off for me to give me some of that downside protection. So if the market really drops, I'm good, right? But then we get into one of these multi-month up cycles, and Nvidia is just crushing it. And this guy's brother-in-law,
Yeah.
who he thinks is an idiot, is all in on these high beta stocks and is crushing it. How many of those people come to you and say, "I can't take it anymore, Lance, you got to put me in XYZ," right? Probably
I will
pretty
tell
high
you,
percentage, right?
I have a lot of clients that listen to the show, so I don't want to say categorically 100%, but I would guesstimate that 99% of our clients are liars. And what I mean by that is that, they come in, they say, "Oh, I'm super conservative, don't lose any money for me, be good." But when the market takes off, they're like, "Why aren't we have more in?" Or when the markets are down, 5, 10%, and their portfolio is down 1 or 2, it's like, "Why are we losing so much money?" It's not, it's just that emotional bias that all humans have. And despite our best of intentions, emotions are still going to try to rule us. And that's where it gets really difficult. And that's where you've got to step back and go, I know that's my emotional bias. I know that's where I am emotionally, but let's actually look at the portfolio and see what it's doing. And if there's a problem, you fix it, right? I've got something that's completely falling out of bed, we sell it, right? Or I've got something that's really overweight, I need to trim it back, and be willing to give up some of the gains. Nvidia is just going off to the moon. Why don't I have 100% of my portfolio in that? Because it's not smart. Because eventually it's going to stop going up and it's going to go down. But this is where we've got to be really honest with ourselves, and in terms of what our expectations are, and aligning ourselves with our portfolio and our goals, not some random benchmark index. The S&P has nothing to do with you. Focus on your goals and say, my goal is to grow this at some percentage rate every year, and build a portfolio that'll do that for you. And that's easy today with yields at 4% on bonds. Building a portfolio that generates 4 or 5% a year is easy right now.
Yeah, and that is a great point, where we do live in a really good time on a relative basis, from where we were, say, 3 years ago.
Yep.
Where you can pursue return with much greater or much less risk than you were able to back then. So just to clarify one thing you said, and then we'll move on. I know you didn't mean it this way. I don't think they're liars.
I'm being facetious, but
I know.
yeah, you know what I mean.
I think they're human, and I think what they're doing, which is this, what you're saying, is we just underestimate. We're bad at estimating risk, right? Just as humans, it's not how we think naturally, and we underappreciate how much our emotions can drive our thinking when we get stressed, right? And
that's exactly the point. I mean, it's always with the best of intentions when we set goals and do financial plans and design models and all those, because those are all very tailored, to every client. Every client comes in, they get with Danny or Rich or one of our John Penn or one of our financial advisors. They set up a very very thorough financial plan. They design goals around that plan for withdrawal rates, for contribution rates, all those type of things. And then they calculate all that for the rate of return needed to ensure the longevity of the portfolio. And that's the goal, right? So the goal is, great, this portfolio needs to generate 6% a year. So we build a model to generate that rate of return for them. But what I mean by they're liars is that it's just that emotional bias of the market comes in. It's like, well, the markets are up 20. Why aren't we up 20? Right? Well, because your portfolio is designed not to lose money, because you can't afford in your retirement state to lose you can't afford to have a 20% drawdown. You can't
afford to lose 20. Yeah, no, exactly.
Right. So it's always that emotional, and that's why I write so much. If you go to our website and go through articles, I've written so many articles about emotional behaviors, behavioral biases, psychological pitfalls, all these type of things, because those are the things that impair investor returns more than anything else. Stock picking is not hard. If you just buy an index and leave it alone, you'll make money over time. But the reason that most investors don't make money in the markets is because all of the psychological pitfalls, they buy at the wrong time, they sell at the wrong time, they chase last year's hot performers, they don't catch the rotation, all those things that occur that lead to bad outcomes for investor returns over time.
Yeah. Well, so, I'm at this conference, and it's a natural resources investing conference. And I'm sure most folks here have heard Rick Rule talk. Rick is famous for being in on a thesis years early, right? Because you can't predict with exactitude, when these trends are going to fully come into their own. And so, he's sort of at the extreme tail end of long-term orientation, right? I'm going to be in this trade. I'm confident in the thesis. I just don't know how many years it's going to take for this thesis to play out, but it's the kind of deal where you got to be in once it hits. Otherwise,
Yep.
you've missed the opportunity, right? So you really need long-term oriented people. So I know, from talking to you and the other firms I work with, Lance, Ted Oakley said it best. He said, pretty much everybody I talk to, I onboard as a new client, you know, swears up and down that they are long-term oriented. We come up with a strategy, we tell them, how we're going to manage this. And, sometimes the market's going to go away, sometimes it's going to go against us, but we've got this long-term strategy, we're going to stick to it. And he said they're totally fine and 100% behind that until the market's down 10%.
Exactly.
And that's exactly where we got to protect from what you're talking about. So I think we've kind of beat this horse dead. But the key thing is, to your point, Lance, you got to be real brutally honest with yourself. It's really hard to do. And my only coda there is if you're not, super confident in your ability to really do that well, that's when you pull in an advisor and say, help me do this. And the things that you mentioned, like the financial plans and stuff like that. That I think is so helpful because it's like the hard evidence that you create in advance, so that when emotions are raging and you kind of can't think straight, you guys can go, okay, well, look, when we were thinking clearly, this is what we came up with. How much of this do you want to change? And people look at it, oh, okay, actually, all this still makes sense. Okay, it's grounding me that even though today feels bad, this still seems like it's going to make sense for tomorrow.
Yeah.
Thanks for giving me the reality check. Let's just keep things as they are. Yeah.
Yeah. And the way we refer to it a lot, it's a roadmap basically. And it's like if you're going to drive from Houston to, if I was going to drive from Houston to come see you in California, I could just get in my car and just start driving down freeways, and maybe hopefully I'll get to where I want to go. But it'd be much easier if I just had a map to get there
Right.
to follow. And that's really what that plan is. And where we go wrong in terms of our investing is that we take what my mom would call the scenic route, which was she would get lost when we were driving somewhere. But those scenic routes can be very costly, and that's those deviations from the roadmap that we want to be careful of. And so, really, this is why we talked about before on the show is like if you can't write down an investment policy statement, you should not be investing your own money. That's just one of your key tests. If you can't write an investment policy statement, you should not be managing money.
Well, and on that, when you were talking earlier, I wrote this note because I was going to ask you. I hear from a lot of people, like I hear Lance saying that when the getting's good, you want to trim back a little bit, right? But people also say don't sell your winners, right? So how do I deal with that? And one of the things that you've said is, well, it doesn't have to be an all in or all out kind of thing, right? And so the question I was going to then ask, which is, okay, so how do you determine what percent to sell, right? And then I think you already gave the answer, which is, well, if your portfolio targets 2% and it's now 3.5%, then sell back to 2%, put those gains into something that's less correlated with the market, right? Whatever, right? That all makes sense. Now, I'm going to guess a lot of people watching, they don't have that rigorous a discipline. They own the stock, but when they bought it, they weren't like, oh, I'm going to make this 2% of my portfolio. It was just, I'm interested in this. I think it's got legs. I've got an extra couple thousand, several thousand lying around. I'm going to put that in next stock. And I would think you would say, look, if you don't have a portfolio target, position size target, you shouldn't be trading individual stocks on your own as well, right?
Yeah, one of the basic tenets of if you read turtle trading or if you read any book by any great trader, position sizing is the number one rule of managing a portfolio, which is you don't build a position so large that it absolutely collapses your portfolio if things go wrong, because things will go wrong. Eventually something will happen, and NVIDIA will take, NVIDIA just had about a 20-25% correction. So maybe more, I haven't checked it, but it just back in March and April, it had a pretty big correction. If you had a big chunk of your portfolio in NVIDIA, you took a pretty significant hit. And that happens from time to time. And so this is why, again, this goes back to what we were talking about earlier about beta volatility. Every stock has a beta, right? So what is beta? Beta is how much does a position move relative to something else? So if I want to know what the beta volatility of NVIDIA is relative to the S&P 500, I can measure that. And so if the beta volatility of, I'm just picking out numbers right now, but just say the beta volatility is 2 relative. So in other words, it's twice as volatile as the S&P. So if the market goes, if the S&P goes up 1, NVIDIA goes up 2. If S&P goes down 1, it goes down 2. So it's got a beta volatility of 2 relative to the markets. Well, that means that if I want to have a position weight in that portfolio, say my normal position, say I'm going to build a portfolio that's equally weighted 5% in every position, but I get to NVIDIA, which has a beta volatility of 2. Well, I can't own 5% of that position in my portfolio because it's increasing my beta more than the S&P. So I can only own 2.5% of that position because of its relative beta volatility to the index. So if I want to keep my portfolio beta relative to the S&P, I can't have a 5% position in NVIDIA, or I can't have a 5% position in Palantir, which has a 2+ beta to it. So that's where you have to, again, this is why it's complicated. It's a lot of math involved, but this is where you've got to start looking at the risk you're taking with each position and saying, okay, I'm not willing to let that position dominate my portfolio volatility because I can't stomach it. If my portfolio is down twice as much as the market, I can't handle it. I can't have that kind of volatility built in. So again, that's why you have to look at each position you own and how it impacts the volatility of your overall portfolio. And that's all about sizing.
Okay. All right. I got to end it there. I'd love to keep drilling on this, but I'm going to be losing my room pretty soon. And there's more things I want to get to.
They're going to kick you
out. So Mike Leibowitz did a bang up job, as he always does, standing in for you while you were gone last week, Lance. But he just came out with a piece on your site, and it's raising a question that I've been hearing more and more in the discussions I've been having on this channel, which is, I would say there's a large expectation that the Fed is going to cut at some point, right? I haven't looked at the data recently, but I think the market's pricing in 2 rate cuts this year.
Yep.
And then several more in 2026. So it seems like the only person who, doesn't think the Fed might cut this year is Jerome Powell himself. But everybody else pretty much feels like he's going to. And the question is this a buy the rumor, sell the news event? Meaning, when the Fed eventually does cut, is that something that could, I don't know if it'd say surprise the markets, but it could surprise investors, that the narrative is, oh, rate cuts great for stocks, Fed cuts rates, stocks should really get a big bump out of that. Could that already be being priced in and it be more of a sell the news event when the Fed ultimately does start cutting?
Yeah, historically, that's the case. Normally, when the Fed's cutting rates, stocks don't actually do all that well. And generally, the reason is let's go back to our earlier conversation about earnings and what drives earnings, which is economic activity. Generally, when the Fed's cutting rates, they're cutting rates to offset weaker economic growth, which is impacting earnings, which is generally dragging on stocks at that point. So, it depends on a couple of factors, obviously, but if the Fed comes in and, cuts rates by 25 basis points, that's probably already priced into the markets. Markets probably don't react strongly to that one way or the other. But if they come in and they cut 50 basis points because we just got a negative employment print, or something's happened, tariffs, Trump, goes off and just does like dramatic hikes on tariffs, and all of a sudden it's had a real big impact on economic imports or exports, whatever the cause is, and they have to cut by 50 basis points, the market's not going to like that. Because again, what will be happening? Well, at that point, all those earnings estimates we were talking about, which were very ebullient going into the end of the year, they've all started getting cut. And all of a sudden, if they have to start cutting earnings, that makes valuations go up, which means now I've got to reprice the market for valuations based on lower earnings expectations. So, I think the real risk to the markets is that the Fed cuts more aggressively than expected, which I don't think that's an outside, what am I trying to say here? I don't think that's an unreasonable expectation that we should ignore. In other words, I don't think there should be a zero bet on the 50 basis point cut later this year because something's happened economically.
Okay. All right. So yeah, I just wanted to get that out there just for those who are kind of salivating that, okay, at some point here, Powell's going to have to buckle and man, that's going to be great for X, Y, or Z asset class. It might not be for the reasons that
Now,
Lance.
if they did now, the markets will rally if the Fed cuts rates by 50 basis points and then does 100 billion a month in QE. The markets will rally on that.
Yeah, and that's a great question. So obviously, then it's going to say, I mean, look, we're not going to get that, Lance. One man's opinion. I don't think we're going to get that unless things are really grim.
That's what I mean.
Yeah,
But
meaning,
by then the
meaning
markets,
the markets will probably have gone through some
yeah,
downward lurching before we see the
yeah, yeah,
response.
yeah.
Yeah.
If the Fed comes in and they're cutting 50 basis points and doing QE, I mean, remember the last time that happened was in 2020 and
Mhm.
markets were down 35%. Fed comes in, cuts rates to zero, does 120 billion a month in QE, and the market goes off screaming. And we have the largest recovery ever in the history of the markets over the next 2 months. Um, so there's precedent for that. But again, you're going to be down 20-30% before the Fed steps in because now they're worried about potentially risk on the banks, which is at the end of the day all they really care about. So, if there's risk coming to the banks and the Fed steps in with QE, markets have already been under a lot of pressure, but that will likely be a buying opportunity, not a selling opportunity.
Okay, got it. All right. And look, I'm just sort of throwing this in just so folks don't think I've ignored it. On this channel, I think even in some of these weekly market updates, Lance, I noted for folks silver's breakout when it got above 35, saying that it could really start moving quickly now that it had broken through that resistance.
Yep.
It's been ping-ponging back and forth between 35 and 37, which sort of proved to be a secondary channel for it. A lot of the people at this conference have said, hey, look, once it gets above 37 an ounce, it could really be off to the races from there. The day we're talking, Lance, silver futures at least are now 38.80, something like that. They're getting close to 39. So we may be seeing a pretty substantial breakout in silver there. I have not had a chance to look at headlines. I don't know if there's any material news driving this or if it's just a purely technical move. I will note that Bitcoin has been on fire the past couple of days, back at all-time highs, up something like 6 or 7% in the past 24 hours. The last time I checked it as of this recording, it was like $117,000, $118,000 at Bitcoin. I'm curious if you have anything to say on that, Lance, one way or the other, but is the Bitcoin move here just risk on steroids?
Yeah, it's just Bitcoin has got a huge proxy for or huge correlation to the stock market itself. So it's very much a risk on proxy. Silver looks really good here, but not technically. It's extremely overbought. Your 3 standard deviations above long-term mean. So if you don't own silver right now, I would not buy it here. You're going to get a pullback at some point. Again, and you look back at history, just going back over the last few years, every time it's done this time of action before, it generally has a decent correction afterwards. So you'll get a better entry point. Again, not a lot, but you get a pullback of somewhat to support. Kind of the gold conversation we had, a month or so ago. You'll get some type of better entry point to buy silver, but it's extreme when you're pushing these kind of extreme overbought levels. You're typically everybody's already in, so typically this is psychologically where it's like, oh, I got to get in now. You kind of miss the boat at this point, so you kind of wait for better opportunity. But then that's just all commodities in general, right? Commodities are very much price driven because they're all driven by futures contracts, which is all buy and sell driven, right? So just when things get really overbought, this is a really good time if you own silver. This is what I talked about earlier. Take a little bit of profit off the table here. Look for a pullback. You get it. Put your money back to work.
All right. Okay. So trades, Lance. I know you were gone this past week, but did RAA make any trades?
Let's see. No, we didn't make any trade. We did a whole bunch of trading. I'm trying to remember. Did you talk to Mike about trades when you did the show with him?
I did.
Because he should have given you quite a long list.
He did. He did.
Okay.
Yeah. And I remember you had said leading up to last week with him that you guys had your shopping list and you were waiting for the time to actually start deploying it.
Yep.
Seems like you guys kind of deployed it then. Have you kind of been just letting the dust settle from that, or have you been actually making incremental trades?
No. So portfolios are right now, they're trading right around full exposure at 60% exposure. If we get some type, and we're kind of going through a bit of a correction right now, we're kind of consolidating this recent run up. Markets are, as we're talking here Friday morning, Markets are down about 35 basis points this morning, nothing major, but markets have kind of been flatlined all week, haven't been doing a whole lot. But if we can kind of work off some of this overbought condition, pull back to support, I would love a 5% correction in the markets. That'd be fantastic. And then I could deploy, another 10% in cash that I've got sitting on the sidelines right now.
Okay, and that would be a real correction, not a micro one like you thought we had.
Yeah. No. To deploy a big chunk of cash, you need a decent setup, and we haven't had a decent setup in about a month and a half. So
how much cash are you holding right now?
About 12%.
Okay.
Yeah, and I want to deploy 10. I always keep 2 to 5% in cash for clients have withdrawal needs or whatever, and I don't want to be forced to sell something to meet a withdrawal requirement. So we always keep 2 to 5% in cash. Generally we'll sweep that into short-term T-bills or something that are yielding 4 or 5%, whatever. So out of the 12% cash, I've got 10% of that I want to put to work, and that'll take us to almost 70% exposure, which I'm okay with if we get the right setup.
Okay. All right. Well, look, let's get to the rant part here. And again, this one's much more of a positive, more gratitude session than it is a rant. But I just wanted to kind of circle back to what I said at the beginning, Lance, of the just immense amount of goodwill that people have been showing me here at this conference. And if you're one of the people who has come up and talked to me, and you're now watching this after the conference, I just thank you again for being so kind and so gracious. The thing that it's really hit home for me, Lance, is there really is a need out there for channels like this. And I'm not trying to make a commercial here for Thoughtful Money. There are other financial influencers that are here. In fact, I was just on a panel this morning with folks like Danielle Camboni and Jay Martin and several other folks who do what I do. And Rick himself moderated the panel, and it really got to the point where people are finding themselves very underserved by the traditional sources out there, and we spent a lot of time talking about this, so I won't rehash it all. But I think one of the things that has made my channel and others like it successful is that people are basically sort of taking their destiny into their own hands. They're saying, look, CNBC just kind of feels like I'm being marketed to all day, and it's more entertainment for views, and it's just sound bites, and it's not really making me a better informed investor. So I'm going to go and start self-educating. And they're consuming media from a lot of different alternative sources, thankfully this channel being one of them. And the appreciation that I'm getting from people to just say, hey, look, the conversations you're having, the experts you're bringing on, the things I'm learning from this have vastly increased my education level in investing and my general financial literacy. But more importantly, like I've actually done better as an investor as a result of this. And to know that we're playing some sort of role in helping improve people's financial agency and destiny is honestly the absolute best feedback that I could get. It's exactly the kind of difference I want to be making in the world. It's why I founded this channel. Lance, you've been a big part of this, and I know that's been a big driver for you and doing what you do at RIA and actually managing people's capital and helping them get to a better destination. So, I got to say, it feels wonderful to be part of a movement that is doing good in the world like that. And as I like to try to remind people, if you're watching this, I mean, I'm one of you. I literally came to this industry from the outside. On this panel, Lance, there's a number of folks, Danielle included, who wanted to be a journalist from age 6 and went to journalism school and rose up through the media landscape. That's not me. I was a professional, at the time, kind of stuck in the rat race in Silicon Valley. And I would get home late at night and be exhausted. I would have missed putting my kids to bed. I'd maybe see my wife briefly before she went to bed. And then I'd get online and I'd go to these websites that, were beginning to educate me about what was going on the macroeconomic side of things. And that helped me sidestep the global financial crisis. So I know what it's like to be in your shoes. And I literally just wanted to try to create the type of content that I most wanted to see as that individual. And hopefully, at least it seems like that kind of content's resonating, at least with the folks that watch this channel, Lance. And that's wonderful. But information in and of itself, it doesn't have value. It's the application of that information. And to hear that people are actually using it to improve their financial trajectory, their financial destiny is just, it's such a gift. And I just want folks to know there's no ego in this at all for me. Like I said, if there's anything I do well, it's hopefully just being a good avatar for you all, and hopefully asking the questions that you would like to ask if you were sitting in the seat that I'm in. And there's no hubris here. I'm very humble about how lucky I am, and I just am grateful to be the guy in this chair. I guess first I just wanted to express that to folks. I really am just a regular guy, and when you come up and thank me for it, it means so much to me. But I also just want to let you know that I don't think I'm doing anything special. I think I'm literally just trying to honor the chair and use it the way that you would if you were sitting in it. But anyways, Lance, you're a big part of this. I wanted you to hear some of that goodwill, but also hopefully I'm sure you got some reflections back on people about, why you're doing what you do here.
No, I do what I do here because I love what I do. So, it's there's the old saying is like, if you do what you love, you'll never work a day in your life, right? And that's it's very true. I mean, I enjoy getting up and going to the office and doing our YouTube show and writing blogs and writing newsletters and doing the show with you here on Fridays. It's kind of the highlight of my day. So I'm more bored when I'm at home trying to figure out something else to do because I don't really have any hobbies to speak of, because I find myself coming back to, hey, there's an idea I could go write about, and I'll wind up, writing about something at, 8 o'clock at night. So
I get it, but let me just dig a little deeper because Lance, I know you. I mean, I know you love doing this, but you don't do it for the personal enjoyment alone, right? I mean, I think you enjoy the mission part of it too. And that's really what I'm trying to underscore here is there is a need for channels like this. And I'm not saying Thoughtful Money specifically, but given the current media landscape where people, and the current lack of financial literacy in our education system, and the current, I would say, sort of general rapaciousness of Wall Street and most financial advisory firms out there, there is a need for a place where people can feel like they're getting authentically valuable, or as I like to call it, financially nutritious information that then helps them make better decisions and actually increases their overall lifetime return. I believe you've got a real passion for that part as well, the helping people part of it.
Oh no, absolutely. That's again, that's the best part of the job. The actual job parts, the managing the money, dealing with the clients, making sure they're successful. Yeah, absolutely. That's, I've said this before, but I would do it if I didn't have to pay bills, I would do it for free, because it's just, the money is not, building the business and growing the firm and doing all that. It's not about the money. It's about helping more and more people. And then we do a lot of free work for people as well. But yeah, it's just, but it's not just me. That's everybody in our firm. It's Danny, it's Rich, it's John Penn, it's everybody you talk to in our firm. They absolutely love their job and they love working with the clients. And that's why we do a lot of, every year we do a lot of client events where we get all of our clients together. We take them out for barbecue or crawfish or whatever, batting cages, just have a good time and just meet up with our clients and talk to them and visit and spend time together, because it's more about the relationships. And, we absolutely love hearing the stories like, oh, hey, my kids just graduated college, got everything paid for. That's awesome. And that's fantastic. The thing that bothers me though about the media and talking to, kind of what, going back to what you were saying, is that the media it's driven by its advertisers. So, two things, and this is why, we talk a lot on our daily YouTube channels, like be careful who you listen to, because, if there's a lot of people that come out with like super, there's an old saying in television, if it bleeds, it leads. So the more bearish the headlines, the more clicks and views it gets. Well, make sure that, the person that's feeding you the information doesn't have another agenda, right? Are they selling you a product, or are they selling you something on the back end? Same conversely with CNBC or Market Watch or whatever. They're paid for by the mutual fund industry. They're paid for by the ETF industry, all the people buying advertising. that's what those channels live off of. And so they cater to their advertisers. So again, that's why it does feel like when you watch CNBC, it feels like you're marketed to, because you are. It's the same
Because no
thing
matter
on,
what happens, it's always a good day to buy an ETF because
yeah.
what our advertisers are pushing it.
And right now, in particular, there was an article out this past week. There's been a 300% rise in scams on financial social media. So again, there's a lot of influencers out there on TikTok that are, promoting financial advice. A lot of these people have no financial experience, they have no financial background. They just started making YouTubes for whatever reason, and they're getting paid for, the more clicks and views they get on their content. That's how they make their living. Nothing wrong. There's nothing wrong with that. Just be careful of the source you're getting information from, because, if I just tell you what you want to hear, great. But do you really want good information? And that's the real challenge, because a lot of times the real good financial advice is not the stuff you actually want to hear. It's like, hey, you know what? If you want to build wealth, you can't do these things, right? If you do these things, you're not going to build financial wealth. You're going to have to sacrifice to save money. Nobody wants to hear that, right? But
Well, just
that's
like you
how
said
you
earlier,
actually
like,
build
hey,
money.
when you're making a killing in the stock, this is the time to actually start selling it, right?
Yeah. Nobody wants
Not
to hear
fine.
that. It's like,
Yeah.
just go buy, here's my TikTok channel. Go buy this cryptocurrency you've never heard of before. There's a 300% increase in these, what's called a pump and dump scheme, where people are starting TikTok channels. They're promoting some low price stock or some cryptocurrency, whatever it is. They already own a big volume of that. They drive up the price of it and they dump it.
That's the modern boiler room.
It is, and it's rampant right now. So the point is just be careful. There is no get rich quick scheme that's going to work long term, and more often than not, get rich quick schemes wind up making you a lot poorer. But again, people don't want to hear that, because we like the whole idea of throwing money in the markets and making big returns in the market. I can build a lot of wealth today if I just buy this cryptocurrency or this stock. It sounds great, and it may work temporarily, but more often than not, it doesn't. And so just going back, just be careful where you get your information from. It may not be me, it may not be from Adam. Just be careful where you get your information from, and make sure that it's really in your best interest.
So this was actually a big part of the question that Rick asked me in this panel, and I want to be really clear that as I mentioned, people are moving to alternate forms of information because they're not feeling well served by the traditional financial media. So I very much feel the weight of the responsibility of the fact that really the only currency that I have at the end of the day with this audience is trust. It's trust that I am going to do my best to try to bring them valuable content, right? That it's going to be to the best of my ability, bias-free, ideology-free, and that I'm going to be trying to bring on, smart guests that are worth their time, and I'm going to ask the right questions to bring out the maximum amount of value in the conversation. And so, folks, I mean, honestly, to Lance's point, if you don't ever feel like you are getting that from this channel, I'd be the first one to tell you to go to the next source that's giving you a higher yield on that, right? It really keeps me humble in the fact that, like, look, I don't want to do anything to call into question that level of trust that this audience has put in me on this. And I know that every time, not everyone's going to love every interview. I just released one with Art Laffer, which I think is a very valuable interview to listen to, especially because he's one of the voices that President Trump is listening to. A lot of people didn't agree with him. And I think that there were enough people who said, hey, look, while I didn't agree with him, I value that Adam's bringing on the alternate opinion, and it's giving me a chance to listen to it. But there are some people who were just like, oh my God, I can't believe that you let this guy on your channel, right? And but I do that to live the trust, which is, look, I'm just not going to bring you, everybody who has a certain ideology, right? I'm really trying to help bring everybody who I think is a valuable piece of the puzzle along. Hopefully I do that well, and you continue watching. If I don't, like I said, I'd be the first one to say, then go somewhere where you're getting a better value than what I can give you. But anyways.
Or tell us what we can do better.
Exactly.
Right? Yeah. Say, hey, look, you had this guest, he's super bullish, have this guest is super bearish, or vice versa, right? have, and maybe at some point, Adam, we need to have more debates where, we get two people with opposing views and we just have a conversation.
I will definitely do that. And actually, there's some folks that would have specifically said they'd love to see you debate some of the other folks around here who are a little bit more, well, it's funny. You're kind of in the middle. So some people will say, I want Lance to argue this bear because I think Lance is too bullish. And I've heard the other way around. So I will definitely work on that. Just FYI, so happy to do it. Debates are a bit harder to organize because you've got now 3 people's schedules, and sometimes some people don't like the format. Doesn't mean I won't try, folks. So just to let you know, if it's a little slower in happening, it's logistics, not my resistance to the idea.
One thing, well, one thing we could do, and again, I agree. The problem with debates also is that they can turn out to be more argumentative than actual debates as well. So it has to be.
But I have an edit button, or I can just not run it if it's not useful.
Yeah. But maybe maybe the other goal is just we just set up, say, hey, look, here's a clip from an interview I had this week. He said this, let's talk about that topic. And so at least that, I think, because I think the most valuable thing to get from financial media is being able to see both sides of an argument at one time. Because again, it's I'm here talking to you right now. Look, my opinion on the market could literally change Monday morning. If something happens over the weekend, and today I don't see anything wrong with the markets. We're having a little bit of a correction. Markets are just kind of working off some really overbought conditions. The market could be down 3% on Monday because Trump says something over the weekend. That's going to change my whole outlook. But you're not going to pick that up because you're not going to hear from me until next Friday with Adam, right? So, but I think the most valuable thing that we can get out of financial media is being able to see both sides of the argument so that I can make a better informed decision. And this is one of the challenges I think you and I both face, is that we tend to gravitate towards, we have every human has a bearish propensity to them. We have a loss bias built into us because when we were cavemen, we didn't want to get eaten by bears, right? So
it's prospect theory. We feel the pain of a loss twice as much of the joy as you get.
Exactly. Yeah. So we tend to gravitate towards that. But the problem is that when you hear that media, right, that's all you hear. You hear a whole conversation about how bad things potentially are going to be. But what we need to have is a better conversation where it says, okay, here's the bearish argument, here's the bullish argument. We can marry those two together and say, and here's the probabilities and possibilities, as we were talking about earlier, 50, 35, 15. I think that's the way to approach it. Say, look, here's my base probability expectation. So at least I can better navigate my portfolio of what to expect and say, okay, well, 50% bullish, I can bet on that, but I need to hedge for this other 50% that may not work out that way.
Yeah, no, exactly. And so to Lance's point about feedback, yes, please share it. And by the way, we love it in general, but just so you know, I read every single comment on YouTube. I read every single tweet on X. I read every email that people send to me. I can't necessarily respond to all of them, although I do think I do a pretty good job of responding to the majority. But I just want you to know, if you do take the time to share the feedback, it will be heard, and we do our best to integrate it.
Do you read all the bot comments on X?
Yeah, I delete all the bot comment on X when I see them. And I'll tell you, the worst is, there's a lot in general, but the worst is there are these bots that will come and carpet bomb some crypto, and you'll get literally, Lance, like 150 comments in 30 seconds, right?
I know, it's crazy.
And the problem is YouTube doesn't have a mass delete button. So I literally have to go through and indivially click delete. It's just, it's so infuriating.
I feel your pain. And my remedy for that has been, now when I post on X, I can only allow verified accounts to respond, which I hate that, because there's a lot of people on X that are really smart people and they have good comments, but they can't comment because they're not verified, which, hey, I agree. You don't want to pay the $8 a month. I get that. But if I allow everyone to comment, it's 150, like you said, it's 150 bot comments selling some, crypto thing or some other scam, person out there. And there's no easy remedy. I apologize for that, but there's just no easy solution for it.
There isn't. I'm still hand deleting those because I don't want to close that channel of communication. It is rough though. I got to say, if X doesn't solve it anytime soon, I'm probably going to follow your lead. But in wrapping up here, I hope you don't mind me sharing this, Lance, but to your point about client events, you and I were brainstorming the other day. You were entertaining.
Oh no.
Yeah. I'm going to put it out there. We're going to see what
No.
you think. Yep. So, I was trying to think of ways in which Lance and I could spend a little bit more time in real life with viewers of this channel that want to spend time with us. And we were trying to think of sort of experiences that we could put together. And I thought of marrying two things that Lance and I have some expertise and skills at, but that could be kind of fun. So I'll do mine first, and then we'll do Lance's. So I love to play pickleball. Folks have heard that. So if you want to come spend the day with Lance and I, and as part of that day, play a little pickleball with anybody that wants to come on the court, play with me. We'll pull Lance out there. I think I've got an advantage over Lance in pickleball, but his dad was a tennis pro, so I think Lance is the sleeper here. I don't think he's going to be a pushover. That could be fun. If you don't know how to play, happy to do a clinic, before we all get in the court to teach people the basics of it. There aren't that many. And then to reciprocate, Lance, a former MMA professional, we thought that he could teach sort of the basics of combat fighting. I think more in the spirit of, here's some basic self-defense. So if you ever find yourself as a 50-plus-year-old person like me in a dark alley and some scary guy comes up, here's two or three things that you could do to get away. But once Lance gives us a little bit of a clinic on it, I'll get in the ring with him and we'll see how I fare against Lance, at least until he knocks me unconscious.
Yeah, that could be fun.
All right.
But look, I'm 60 years old. I got a bum shoulder. We'll have to work it out.
What you're trying to actually intimate that I could maybe do a little bit better against you than
maybe.
I don't think so.
I'm never overly confident,
buddy. I got my own ailments and I've got no training like you have.
All right, I'm game. I mean, I need to learn how to play pickleball for sure.
All right. Well, look, folks, if that's something that you would enjoy either experiencing in person by spending the day with us, playing a little pickleball and getting in the ring with Lance, or watching me getting the stuffing beat out of me by Lance, let us know in the comment section below. Probably too hard to engineer, but if folks couldn't attend in person, but we had somebody there with a video camera, at least catching the highlights, maybe we could, let people participate vicariously from their laptops if they can't be there in real life with us, Lance. But anyways, folks, if that sounds fun, let us know. If it sounds terrible, let us know and we'll scrap the idea. But we thought that could be a fun way to spend a day.
I think the pickleball sounds like a great idea.
I mean, it's a lot of fun. There's a reason why it's America's fastest growing sport.
Yeah, I agree.
I was a tennis player my whole life. I understand that a lot of tennis, purists look down their nose at pickleball, but I got to say, don't dismiss that out of hand. It really is a lot of fun.
No, it's the same way I was growing up. My dad was a tennis professional back in the 50s and 60s. He played Poncho Gonzalez. He played the circuit, the whole 9 yards. And he was determined to make me a tennis player growing up. And of course, as a rebellious kid, as I was, I went and played racquetball, which, he
probably irritated him to no end.
Racquetball destroys your tennis forearm. So, he looked down on that. So he would absolutely despise pickleball, let me tell you.
Well, folks, anyways, hopefully there's enough interest in that we actually do make it happen. If not, Lance, you and I can just get together and I'll beat you on the court and then you'll beat me.
Anytime.
All right. Well, folks, if the only other thing that sounds more fun than that to you is watching Lance Roberts on this channel week in and week out in these market recaps, please let him know that by hitting the like button and then clicking on the subscribe button below. As a reminder, we are trying to get to 150,000 subscribers on this channel by the end of July, which is my birthday. If you have not subscribed yet, would love your help in that. It only takes a second. Just click that subscribe button. And it really does help us. There's benefits both ways. If you click the subscribe button, you'll get alerted every time this channel publishes a new video. So it helps you. And the more subscribers we have, the more attention the YouTube algorithms gives this channel. So it actually helps this channel succeed. So again, that 1 second effort on your part really does make a big difference. And if you'd like some help in, managing your portfolio, either through the 3 months ahead that might have those different probabilities that Lance laid out for us earlier, or the longer term potentials in the market with some of those big macro risks lurking, as I've said many times already in this conversation, I think most viewers would benefit from getting the guidance of a good professional financial advisor, importantly, one that takes into account all the macro issues that this channel discusses. If you've got a good one who's doing that for you, great. Don't mess with success. But if you don't, or you'd like a second opinion from one who does meet that criteria, one of the firms that appears with me on this channel week after week, perhaps even Lance and his team there at RIA, then please consider scheduling a free consultation with them by filling out the very short form at thoughtfulmoney.com. It takes you only a couple seconds to fill out the form, and once you do, the firms will be in touch with you very swiftly. Lance, my friend, as always, great talking to you. Very glad that you're back in country. Look forward to picking things up with you next week. As usual, I'll let you have the last word.
No tax on tips, right? So that's been an interesting thing, because in the UK there is no tipping, which I think is a culture we need to adopt here.
Sure. You know, it's funny. I was talking to somebody about this, and they were like, kind of the reaction to a lot of the people who make money on tips in the US is like, oh, okay, great. I guess I just will feel less bad about not having declared my tips. Like their life's not going to change. It's not really going to save them that much more money because they already weren't declaring their tips, right? They can just feel less like a criminal now, right?
No, my wife and I were just kind of, amazed when we were in the UK, because we're so used to every time you go somewhere, like you get you walk up to the counter, you order a cup of coffee, you pay for it, they flip the screen around, it's like, 20, 25, 30%, whatever for a tip. And there's no tipping in the UK. And it was like, I kept just out of habit looking for where to put a tip, and there's no tip. And I'm like, this is great. I can really get behind this.
I know. And I got to tell you, look, I mean, one, I very much empathize with people who rely on tips for a living. I mean, I get it. But as we've talked about, Lance, tipping culture has gotten out of hand. And actually, this hotel I'm staying at, the prices are ridiculous. And so last night I missed dinner, came back late to the room, looking at the menu, and I'm like, God, these prices are just bananas. So I order a child's hamburger, right? They deliver it. It's $20 hamburger, right? So they deliver it, and the guy, very kind, brings it into my room and mentions something about, oh, here's a line where you can put a tip if you want. So I put a $5 tip down. So he leaves, and then I look at this thing and I realize it's a $20 hamburger, right? But they've put in a $5 delivery fee plus a $5 gratuity. They already put the gratuity in. So I just gave them an extra $5 on top of that, right? So I paid 15 more than the $20 hamburger. So I open this thing up. It is not one hamburger, it's two hamburgers. Lance, they are so small, both fit in the palm of my hand. And I'm like, oh my God, I just paid $35 for maybe like 10 grams worth of meat.
That's shrinkflation right there.
It was just unbelievable. So anyways, yes, anyways, it would be wonderful to adopt more of a less of a tipping culture here than we have in the UK. But I will say I'm happy for those who depend on their tips. Whatever.
And I'm a good tipper here in the States. So I tip well, particularly tip well for good service, because I know I waited tables growing up. My wife's waited tables growing up. All my kids are waiting tables now. So our whole family is very ingrained in that culture. We know it, and we know how hard that you work for that. And my problem with tipping is when I go to the counter, I pay for it,
you do all the work.
It up, I have to bust my own table, and that I have a problem with that tipping. But if you're waiting on my table, busting my table, taking care of me, providing good service, I tip very well because I know how hard the work is.
Yeah. But I will say the spin kiosk is pretty infuriating, right? Yeah. All right. Well, look, we'll end it there. Lance, my friend, like I said, very glad you're back in country. We'll see you next week. Everybody else, thanks so much for watching.
The price has been going up, but it's been driven by the East, by Asia. It's not the U.S. and Europe and Australia and so on. It's not the West doing this. It's the East that's been causing the $1,000, the 48% price increase in gold this year so far in just 9 months. It's when the U.S. does come rushing in, and they will. then we're going to see some real fireworks. But it's better to buy gold at $400, $500, $600, $700 an ounce than at $3,600 an ounce. But it's not too late. $3,600 is going to look like a great price. You're going to look brilliant in the future when it's 5,000 with some other digit in front of that 5,000.
Asia, not the West, has been the primary driver of gold's latest climb, which has fueled a 48% increase this year. Asia is currently leading the rebound, but it might take off when investors from the US and Europe join in. Goldman Sachs has warned that gold may increase to $5,000 if the Fed's independence is undermined. Such forecasts are perceived as reliant on robust investor flows, which erodes trust in conventional safe havens such as the dollar and Treasury securities. Mike Maloney, a precious metal expert, argues that $5,000 gold is far too low, especially if Trump undermines the Federal. Big names like John Paulson, J.P. Morgan, and Goldman Sachs now call for $5,000, but critics say that figure ignores today's massive debt and weaker dollar. Gold is up about 40% this year, with expected continued gains driven by the weaker US dollar, Fed rate cuts, geopolitical risks, and increased demand from central banks and ETFs. A correction of 5 to 6% is possible, but many expect gold to top $5,000 per ounce in 2026. Historically, even a small wave of investors piling into gold can trigger a rush from stocks and real estate, sending prices soaring well past $5,000. For now, analysts note that Western institutions are beginning to increase exposure to gold via ETFs and other channels, which could trigger strong upward momentum once that catch-up demand intensifies. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think actually it's if Trump undermines the Fed, with gold, 5,000 is a ridiculously low price. It's just stupid, idiotic low. You have to put a 1, a 2, maybe even another 5 in front of that 5,000. But the very fact that they are saying this, and John Paulson just said $5,000 an ounce, and J.P. Morgan just said $5,000 an ounce, and people are reading it. So Goldman Sachs has finally woken up. I was saying, my analysis in my first book, I had 3 different ways of looking at it, and I came up with a range of the low 6,000s to the mid 6,000s. But that was back then when the debt was so small and when the dollar was, in a much better position. But the main thing here is that Goldman Sachs is writing positive stuff about gold. They were so negative on gold when gold was $700 an ounce, $400 an ounce. That's when, no, you don't want any gold. You want what we sell. Now, gold has proven them so wrong. All these people, J.P. Morgan, Goldman Sachs, they are so incredibly wrong year after year after year. And now they're jumping on the bandwagon here because they're looking like idiots. But the fact that they are saying this, even if Trump does nothing, could cause gold to go to $5,000 an ounce. If Trump does something that undermines the Fed, $5,000 an ounce is an absolutely idiotic prediction. It is absurdly low. First of all, if anybody that bought the Great Gold and Silver Rush of the 21st century and they've read the chapter on Giffen goods and about the panic that happened back in 1979, first month of 1980, and then the differences between the bull market of the 70s and today, if 1% start going toward gold and it goes toward $5,000 an ounce quickly, then 2% are going to go, 3%. And then there's going to be a rush of a whole bunch of other people where it's not treasuries that they're selling, it's other things that they're selling. It'll be stocks and real estate, and everybody starts to gravitate toward the thing that's going up fastest, toward the thing that is the ultimate safe haven investment, especially in turbulent times, war, all of this stuff, when the public comes rushing in, and they're not right now. The price has been going up, but it's been driven by the East, by Asia. It's not the U.S. and Europe and Australia and so on. It's not the West doing this. It's the East that's been causing the $1,000, the 48% price increase in gold this year so far in just 9 months. It's when the U.S. does come rushing in, and they will, then we're going to see some real fireworks. But right now, Asia has lit the fuse, and this is part of lighting the fuse. Goldman Sachs writing this stuff, JP Morgan writing this stuff, and big successful investors like Paulson writing this stuff. Now that it's getting out into common public knowledge, but I want to, again, my predictions on this were 17 years ago. And it's better to buy gold at $400, $500, $600, $700 an ounce than at $3,600 an ounce. But it's not too late. $3,600 is going to look like a great price. You're going to look brilliant in the future when it's 5,000 with some other digit in front of that 5,000.
Mike points out that while Asia is driving today's gold rally, the rise might become explosive if the United States and other Western countries join in. Gold's rise is driven by forecasts of U.S. rate cuts and declining real interest rates, which make it more appealing as the currency depreciates. Demand for safe havens is increased by the OECD's warnings about stagflation dangers and negative real rates. The surge is being driven by Asia, but Western investors are starting to follow suit, which might increase gains even more. However, after Nixon terminated Bretton Woods, gold first increased under positive rates in the 1970s. However, the real boom was powered by negative rates once Americans and Australians were permitted to purchase. According to Mike, the official CPI may be understating inflation in comparison to today. The use of shadow statistics from pre-1980 techniques indicates that we are already in negative real rate territory. These circumstances could work as gold's rocket fuel, indicating substantially greater prices to come, especially with rate reduction on the horizon.
And we're already going north because of Asia. And if we start buying, Asia is good. Now, I want to remind everybody, if they really need, a lot of people viewing this have read The Great Gold and Silver Rush of the 21st Century. But in the first bull market in the 70s, it was a very small percentage of the world's population. It was like 5% for the first half of the 70s. And then from 75 to 80, it was about 10% of the world's population. This time, it's that same percentage plus all of it. I mean, it's everybody except North Korea participating this time. And so it's complete. When people say, oh, this time it's different, with gold and silver, it's the only time that statement is true. This time it is different, really different. Oh, you'd have gold price, rates, and the CPI to create the negative real rates. So you've already got three, but add one more column of the shadow government statistics, alternate CPI, which I keep on reminding people, it's not like conspiracy theory stuff. It is government numbers. It's the CPI as used from World War II to 1982. So it's just the way the government used to measure consumer price index, and make, you've got red. It would be good to add some more stuff. So you need colors, but remember, people that are color challenged, it's red, green. So you don't want to use both those colors on the same chart. But I want to point out, the first half of the 70s bull market, we were in positive rates. But that portion of the gold rising was from the date that Nixon took us off of the Bretton Woods system, but it was still illegal for Americans to buy gold. It was only Western Europe and Canada participating. Australians couldn't buy. American citizens couldn't buy. There were no markets in the USSR, so everything inside the Iron Curtain, all those countries, China under Mao, they could not participate at all. And so that was the only area during these red boxes that you've pointed out where it's predominantly negative interest rates. Once the US joined the party and Australia joined the party in the 70s, which happened the first day of 1975, we were in this negative real rate territory, and we stayed there until gold peaked. And the second that they cut rates, we are in that negative real rate territory. We're it doesn't show us being in it right now, but we probably really are. I would love to see this with shadow government statistics, alternate CPI. And we might want to do a column that averages the two, because I do think the truth lies somewhere in the middle of the old government numbers, the original CPI, and the new CP lie. And so it'd be neat to have our own inflation indicator, the goldsilver.com inflation indicator that's just averaging the two, previous government numbers, new government numbers.
Could gold prices swiftly rise beyond $5,000 and reach far higher levels if Western institutions greatly increase their exposure to the metal? Is this gold cycle essentially more robust than the boom of the 1970s given the current low real rates and high debt levels? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So that would argue that I still think it has to go a lot higher over time. But I think a reasonable target of 4,000, I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. People who are going to talk about, the Hunt brothers and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple-digit price of silver is a legitimate target.
In Asia, especially China, gold is still seen as real money, and that perspective is spreading among BRICS nations as they move away from reliance on the US dollar, a trend that strongly supports higher gold prices. China's central bank continues buying gold. In August 2025, it purchased about 2 tons. BRICS nations are developing alternatives to dollar-based financial infrastructure, including digital payment systems and local currency trade. Gold is increasingly seen as a neutral reserve asset among these countries. Given these shifts, a long-term target of $4,000 for gold looks reasonable. Silver also has enormous potential. Adjusted for inflation, its 1980 peak near $50 would be closer to $200 today, making triple-digit silver a realistic and justified goal. Peter Grandich, a veteran market analyst and financial commentator, recalls that back in the 1970s and early 80s, few believed the Dow could ever reach 3,600, let alone 36,000, but history proved otherwise, just as today many doubt gold's ability to climb much higher. The reality is that fundamentals for gold have never been stronger. De-dollarization is accelerating across Asia and the global south, with central banks and retail investors boosting gold purchases and trade in local currencies rising. BRICS nations are building alternatives to dollar-based systems, and gold is increasingly viewed as a neutral reserve asset. China continues steady gold accumulation, though its reserves remain low compared to its economic size, leaving room for much more buying. Analysts expect this sustained demand to lift gold's floor higher, with BRICS discussions of gold-linked trade further supporting long-term price growth. BRICS nations are exploring dollar-free trade, with gold discussed as a potential benchmark or backing asset, though no unified gold-backed currency exists yet. Rising central bank demand, especially in Asia, is lifting gold's price floor, while silver also shows huge upside, with inflation-adjusted targets pointing to triple digits. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article. We value your opinions.
For 13 years, the Dow only traded between 700 and 1,000. In fact, the very famous Business Week front page said equities are dead. Wall Street was extremely bearish. And an unknown young man came out of Gainesville, Georgia, named Robert Prechter Jr. with a philosophy and a technical analysis no one really knew of, Elliott wave theory, and said the Dow's going to 3,600. And they just prosecuted him to call him every name in the book. And then when the market took off, he became popular, and then he made a call about the crash in 87 along with me. And the perception was, how could it possibly go to 3,600, let alone a few decades later, 36,000 and more? So that same feeling's in gold right now. People, especially people that have been bullish and profiting from it, this 36, this is way out of line. Yeah, it's great. It give you all the reason, but how could it go a lot higher? It's not possible. You have to take that same philosophy. There's no reason it can't. In fact, I would argue it's not cheap anymore. Someone that was buying it at 1,300, seeing a tripling. But the fundamental argument for gold has never been better. We had at one time suppression by central banks who were offloading it. Now they're the biggest buyers. We had clearly not any society thinking it was money. Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So I think the more important way to answer your question is not talk about some of the general stuff or inflation or even against the stock market, is to admire how it's performed in an environment wasn't as conducive as it is now. So that would argue that I still think it has to go a lot higher over time, but I think a reasonable target of 4,000. And remember, when you're in all-time highs, other than a psychological number, there's no real resistance. So, pick 4,000. Yeah, that'll be a round number and so forth. And, Wall Street has treated gold like kryptonite. I think 0.5% of portfolios are assumed to have some exposure to gold. Can you imagine if people just went to 1 or 2%? It's still a very, very viable market for the long term. Well, I think it's going to play a significant role in the BRICS. They have not acquired all of this gold as a trade or personal investment. They certainly can't flip it to someone that's going to pay even more so they profit from it. I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. I don't think there's a worldwide situation coming anytime soon, because I think things have to get a lot worse before people realize how messed up we been with fiat currencies. I do still think that one of the ways that they're only going to be able to sell treasury bonds, especially long dated ones, a year from now, because I'm a big believer that short rates can fall, but long rates are only going to go higher. I think that's going to find a way that the Trump administration could reprice its gold that it owns to whatever the current price is, and also introduce longer term 40 or 50-year bonds with some sort of gold backing in order to get people to buy it. I think that's going to be how difficult it's going to come for the United States to fund itself, while other world bond markets, as we speak, are imploding as well. 180, and it was profitable to treat it as the second-class citizen to gold. But earlier this year, when it dipped under 30, when I looked at the fundamental argument, it was never stronger in the 41 years I've been involved. So I became a silver bug. And I also said it probably would lead gold for quite some time to come. And I think that's happening here. I think you make an excellent observation. People who are going to talk about, the Hunt brothers and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple digit price of silver is a legitimate target. First of all, it's not that much more than a double from here. It sounds like a lot because for a lot of years it was single digits, low price. But I think it has every reason to continue to rise with gold. And the competition for it, the stock market, I have to throw this in. I made a big change a couple of weeks ago. I was not in the stock market crash camp. I my January forecast for our clients was the stock market was going to be either side of unchanged. I told people to avoid U.S. equities, get into world funds. I love the Chinese market. But a couple of weeks ago, stuff just screamed that we were very vulnerable to a hard fall or even a crash. And that has been competition to gold and silver and also cryptocurrencies. And so a lessening of the bull move or an actual decline, as long as it's not a total crash, could only aim the gold and silver. You know how I know that, Jesse? I left the metals and mining industry as a main place of business for myself in 2013. I dipped myself back in 5 years ago when I got very aggressive in gold and mining stocks and all. But I'm hearing from people in the last few weeks that I haven't heard from in 10 or 20 years and saying, hey, I was looking up metals and I saw your name. I thought you left the business. And then, of course, the follow-up question is all the same. So what do you like? And I think we're just at that stage now where, other than that little audience that always confined ourselves to, we used to call ourselves the hard asset crowd. I don't think we say that anymore. It's being broadened out to generalists. And I think that's going to bode to help the metal prices higher.
Peter mentions that the mainstream U.S. financial media won't highlight gold and silver because of their ties to Wall Street. But once public demand grows, that will change. Major gold producers are already generating huge cash flow and could see much more interest as generalist investors notice their outperformance. The largest gold miners reported record free cash flows, revenues, and profits in Q2 2025. Margins are very strong. However, production has fallen for some majors. Juniors are expected to outperform seniors in this cycle due to high leverage and exposure in exploration and resource discovery. Established miners are expected to continue reporting strong cash flows, using capital for dividends, buybacks, and to shore up balance sheets. Despite strong gold price performance, analysts, including Peter, believe gold stocks are lagging and undervalued relative to gold itself. Analysts are watching for better leverage to gold, and many see additional upside as investor attention and valuations catch up. Let's dive into the interview.
Well, much of the mainstream financial media in the U.S. is tied to the hips of the financial service community. They're not going to write things go against it. They're advertisers, So I never expect them to write glowing stories about that, because gold and silver have been treated like kryptonite since I've been in the business by the financial service industry. And I don't expect that to change until the public overrides that demand and says, hey, listen, I'm listening, or I got this neighbor and they're killing it, and blah, yada, 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 yada. And so that's when I think the public will come to it. The mining stocks, even the exploration, and they're two different species, and I'll address them both. The mining stocks, as I said earlier, when I originally sold some of my physical gold in the beginning of the year at 3,500 to buy the major gold producers, which greatly outperformed the performance of the physical gold, they have many quarters ahead of just unbelievable, legitimate printing money through free cash flow. And what will happen for them and what will keep that sustained for them is, as we peter out in the stock market here, and we're seeing a lot of companies now not meeting the low-end earnings estimates, so they can always say they beat them, these generalist money managers are going to hear about these mining companies. Look at Newmont Mining. Maybe today, as you and I record, depending on if Palantir gets hit enough and Newmont is rising, it's going to be the best performing stock in the S&P 500. Right now, it's number 2. And so that means it's outperforming 498 other general equity stocks. And yet, I would tell you that if we looked at people's portfolio, not half or 1% have Newmont Mining in it. So there's still so much upside demand for mining shares, and they should do well. But where I went to, and it's the most riskiest and speculative end of it, and remember, Wall Street created the word speculating, so don't really call it what it really is, and that's gambling, where you have to be mentally and financially prepared to lose part of all your capital. But the juniors is really where we're going to see a really bang for the buck. We're already seeing that in some incidents. And the reason is the world has not only shrunk to where companies can go and without too much risk and try to find the metals that are so critically needed now, everybody realizes, but the amount of money that has not gone into that industry to find these things. And remember, even if you hit it tomorrow, that you just went to a rock and drilled and it doesn't work that way, it takes several years of exploration and all. It's probably anywhere minimum, depending where in the world, 10 to 15 years before it comes out and pours the first metal and all. So when that recognition is realized by everybody and everybody realizes how we're scrambling, a gentleman made a good point to me the other day, and it was Sam Lee, it's actually the largest stock that I own, North Island Copper and Gold. And he was just on a trade mission for Canada to South Korea and Japan. And he made a very good point is, even though they're world renowned for producing so much of the stuff we need, technology stuff, appliances and all of that, their entire base of metals that they need is from outside their country. They don't have any real own supply of their own. So here we have the world is scrambling for critical minerals and all. There's not been a lot of money put in them. I think that's going to make exploration companies become darlings for a period of time. And the majors, their currency is so strong now because of their stock, they're not going to try organic growth. They're just going to go out and buy because we're still seeing good deposits selling for as little as $20 an ounce with gold at 3,600 and going higher. So to answer your question, I'm sorry for being long-winded, but I just think the mining shares and the exploration stocks, their day in the sun to where everybody's seeing it hasn't even arrived yet.
Metals and miners are poised for a solid next run higher, with fundamentals stronger than ever. Will the formalization of a gold-linked trade system by BRICS eventually hasten the move away from the US dollar? Is it possible that cheap mining stocks may eventually overtake gold's performance and produce disproportionate returns in the upcoming cycle? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
China is buying gold like crazy. The people in China are buying gold. They love gold, and the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system, and they plan to build gold vaults in many other countries. Gold is clearly in a secular bull market. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable.
China is both the largest gold producer and a heavy buyer, with its people and central bank consistently accumulating gold as a hedge against the US dollar. China is building vaults abroad to back trade in yuan with gold, challenging the dollar system. China's central bank has increased its holdings of gold for 10 months in a row, ending in August 2025. Their gold reserves rose to about 74.02 million fine troy ounces. Gold is in a long-term bull market, and while a sudden surge to $8,000 to $9,000 within a year or two could signal a bubble, the current steady rise looks healthy and sustainable, pointing to much higher prices ahead. Florian Grimmies, a precious metals and cryptocurrency analyst and investor, highlights that central banks in China, Russia, and India are buying gold instead of Bitcoin, while the US is pushing into digital assets to maintain dominance, raising concerns about surveillance and sustainability. A World Gold Council survey shows 76% of central banks expect to raise gold reserves in the next 5 years. China has boosted its gold reserves for 10 straight months, joining Russia and India in favoring gold over Bitcoin, which remains too volatile and unrecognized as a reserve asset. Rising stagflation risks, low growth plus high inflation, are driving demand for hedges like gold and real estate. Analysts warn that while gold's inflation-adjusted price is at record highs, steady demand could lift it toward $3,700 to $4,000 per oz by 2026. Tracking wealth in gold or Bitcoin, rather than just dollars, shows how purchasing power continues to decline. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
The Chinese, the Russian, and the Indian central bank are buying gold and not Bitcoin. The Americans desperately need something new to continue basically running their hegemony, and apparently they decided it's going to be the digital asset space. It makes sense to a certain level. At the same time, a digital dollar as a stable coin is just really much better. No, it's not. I mean, I'm very much worried about the whole surveillance kind of thing. I'm not sure if Trump himself really understands the whole thing. I think he has a lot of advisors who are telling him what to do and what to say, but if he really understood it, I don't know. It probably is the last chance that America can do, because they are not having enough gold.
You know, it's interesting. I read recently that Trump's assets, his corporate and family assets, have shifted from real estate predominantly to now crypto and Bitcoin predominantly.
Of course, it's amazing. I mean, who would have thought that, right? A year ago. To a certain extent, I would say yes. I mean, I think, first of all, the Trump family just wants to make as much money as possible.
Okay.
So that's, I think, the major intent here. And I think it's very questionable what's going on here. Very questionable. But at the same time, of course, I mean, the administration before was also extremely questionable because they were completely against it.
Yes.
Didn't allow any invention here and progress. So I at least that's what I appreciate now with Trump. But I think it's a turbo casino capitalism kind of style here. And Trump makes sure that his family makes a fortune here. And anything else, I don't know. Is it really better? I mean, yes, they create more demand for US treasuries if people buy more Tether, and then this is getting converted into the crypto market. Yeah, okay, but is this really sustainable? I don't know. I mean, the whole thing is more and more questionable in my opinion. Yeah, exactly. That's what's going on. On the one hand, massive expansion of the money supply, and not only in America, all over the world. If you look at these numbers for the European Union, if you look on Japan, on China, everyone is basically printing money. And on the other hand, the consumers are losing the confidence in these currencies, in these fiat currencies, because they see that they have less and less purchasing power. And so people are trying to escape into hard assets. And that's why, at the end of the day, real estate is still holding up rather well. Okay, there is regional differences, but overall, it's holding up well. And in many areas, actually, real estate is still getting more expensive. Your stock market overall, even though there's lots of questionable things happening in the economy, and you see that basically a stagflationary kind of scenario, the stock market is higher because people buy these stocks as a hard asset, so to speak, moving their money out of the fiat world. And gold, precious metals, mining stocks are moving higher, and crypto as well. And even your rare stamps and your old timers are getting more expensive because the fiat money is losing purchasing power and people losing confidence. I mean, you can see it in many countries, the society is becoming rather unstable. Some of them are actually close to a civil war. These are all the consequences out of it, and this is just continuing. You know? I don't see a turnaround. It basically says that on the one hand, central banks, politicians, increasing the fiat money supply, basically printing money out of thin air. And on the other hand, consumers and participants in these financial systems are losing the confidence because they can see that the purchasing power of their fiat currencies is diminishing by the day in the end of the day. And that's basically happening at the same time. And what it means is your assets or your investments can go up on a nominal basis, while in real terms, they haven't moved at all. But people only look at the value of their assets in nominal terms, meaning in dollar. I mean, how many people are actually looking or calculating their net worth in Bitcoin and in gold ounces? It gives you a totally different picture over a 5 or 10 year time frame than just looking at it in terms of how many US dollars am I in total, or how many euros or Canadian dollars, right? So I'm doing this as a little homework every 4 months. updating a little Excel sheet, tracking my net worth, and you can see how challenging it can be actually to keep up in terms of Bitcoin and gold with your total net worth. You know, you might have more euros or dollars, but not more Bitcoin and gold.
Florian recalls, in 2022, when the Fed hiked rates, Bitcoin crashed, and gold dipped but held much stronger as a safe haven anchor. Since its triple low 3 years ago, gold has risen over 130%, supported by 4 key drivers: expanding global money supply, the bond bear market pushing institutions toward gold, massive central bank buying since sanctions on Russia, and China's relentless gold accumulation for both citizens and reserves. China, already the largest producer, is building vaults abroad to back trade in yuan with gold, challenging the dollar system. This shift is unwinding decades of paper gold price manipulation, as physical demand now drives the market. Beijing is also making gold imports/exports easier. It's seeking feedback on streamlining licensing processes, longer valid licenses, more customs offices authorized, to smooth gold trade. China's consistent accumulation supports the idea that demand from major sovereigns is backing gold's secular bull market. The fact that China is pushing through regulatory/reform steps for gold import licensing underscores a long-term strategy rather than a short-term bet. Central banks globally continue with strong, steady gold purchases in the face of geopolitical risk, inflation, and concerns about U.S. dollar reserve dependency.
First of all, in that 2022, when the Fed started hiking interest rates and everything came under pressure, Bitcoin went down to $15,800 from $69,000, and gold came down to $16,15 from 2070-ish. And had a triple low, more or less 3 years ago. But gold held up much better during that time than everything else. So I remember being very happy having a large chunk of my portfolio in physical gold, because it basically stabilized and was rather in a safe haven anchor in that time when everything else was plummeting. So since then, yeah, gold is up 130% since that triple low 3 years ago. And you asked for the driver. So in my presentation yesterday in the morning here at the conference, I presented my take on it. I think there's 4 big, very important macro drivers for gold. The first one, I mentioned it before already, M2, money supply, the liquidity basically in the system, constantly being expanded over the last few years, and especially now again in the last few months. And not only in America, but also in the Eurozone, in Japan, in China, wherever you go basically. If you would look at South Africa or Brazil, you would basically see similar numbers. So liquidity expansion. Second big driver is the bear market in bonds, especially in the long-term bonds. So the long end of the bond market, I think the Fed has lost control over it already. We have still a rather persistent inflation. And if you're an institutional investor and you have to seek safe, conservative long-term bonds, and now you're in a bear market in bonds, it's very challenging. So I assume more and more institutional money will go into gold because it's the only other asset that they can buy. So that's the second driver. The third driver is central bank buying. We haven't seen that in like decades, that strong demand from central banks. Of course, it increased dramatically since Russia invaded Ukraine, when the whole world realized like, whoa, the Americans, NATO, the Europeans just can confiscate our assets whenever, however they want. So now lots of emerging market central banks and nations are trying to diversify themselves out of the dollar, out of the euro, de-dollarization. Central banks are buying gold. They don't chase gold, but they also don't really care about $100, $200. So that's exactly what we've seen over the last 14 months. Whenever there was a consolidation in gold, you didn't really have a big pullback because very quickly physical demand showed up in the market again. And the last one, which is also very important, probably the most important besides the central banks, is China. China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries.
Yeah.
So if they do their trade business with Saudi Arabia and they buy the oil from the Saudis, they will give them the renminbi, and the Saudis can take these renminbis, go in their own country, go to the vault. Here's the paper renminbi. Show me the gold. I mean, this is what the Chinese are working on, to inject confidence into their yuan kind of system, building an alternative system to the US dollar system. And that's not going away. Those 4 drivers that I just mentioned, I mean, they're going to be around for the next 1, 2, 3 years at least. It could maybe take a decade or even longer until this fully plays out. And I think during that time, gold will be strongly supported. There will be strong physical demand. And out of the consequences also out of those 4 drivers is that you are seeing now the unwinding of that 50-plus decade Anglo-Saxon paper gold Ponzi scheme kind of system, right?
Yeah.
So we know that in the past 5 decades, the price making or the price finding for gold has been dominated by trading 200 paper ounces of gold for 1 real ounce of gold. That's how mainly the price finding has basically happened. And this is being unwinded now. And this can take a long time. And again, I just mentioned it before, gold is super strong, no real pullbacks here, no dips, people chasing, running behind the train. It just pushes higher, and whenever there is a dip, immediately big hands showing up with physical demand. And I think it's super bullish. Gold is clearly in a secular bull market. I think the price targets that you and I were talking about 5 years, at around $9,000, if you remember.
Yeah.
I think that's still the case. We probably have to revise them, and it's probably going to go even higher. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable, and we're going to see much higher prices. And this can last for at least a few more years, at least.
Could China's gold-backed trade strategy accelerate the decline of dollar dominance in global finance? How might central bank gold buying continue to influence prices compared to private or retail demand? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, thank you for being with us, and wait for the next updates.